So very good morning to everyone. I am Ankit Kanodia from SmartSync Services, a SEBI registered investment advisory firm. Welcome to the 7th episode of Mission Smile Guest Webinars, a new Mission Smile initiative where we invite guests from the industry every month and learn from their unique investing style. Before we begin, I would request everyone to please keep yourself on mute and switch off the video so that we can have a seamless discussion and soak in all the knowledge. You may type in your questions in the chat box. We'll take all the questions in the end of the session. Regarding the questions, again, you may ask questions related to whatever will be discussed by Tushar, or you may ask anything related to any theme or sector. But please avoid asking questions like "ये stock कैसा लग रहा है" or something like that. So don't ask arbitrary questions related to stocks. Stick to the question or stick to the theme of the presentation today. Okay, so let's begin now. Today our guest is Tushar Bohra. Tushar is the co-founder and fund manager at MK Ventures, a proprietary investment entity. Tushar is a passionate and versatile bottom-up stock picker with 10 years journey as an investor, having made a career switch to investing after several years at consulting. He is an alumnus of IIM Calcutta. Besides investing, Tushar is also passionate about writing and is an active blogger. Many don't know about this facet of Tushar. In fact, he has also authored a book titled Ouch, Middle Age, which is available on Amazon Kindle. I personally know Tushar since 2018 through a common friend, Sumit, and I have high regards and respect for Tushar for the clarity of thoughts he has. Just for starters, he was extremely bullish on Tata Elxsi even in 2019 and had a clear idea as to where he saw the company in the next 5 years. Today, Tushar is going to touch upon several such businesses as case studies to drive home his investing lessons. So let me just share the presentation and I'll just run the usual disclosures before I'll hand it over to Tushar. So this is the topic of today's presentations: 10 lessons in investing, a 360-degree view with multiple case studies from Tushar Bohra's own investing journey, right? So I start with the disclosure from Tushar's side first. So please do not take this as any recommendation. He will be covering a lot of businesses which will form part of a case study in terms of driving home the point about all the 10 learnings he's going to talk about. Similarly, it is fair to assume that in few of the stocks, I and SmartSync Services may also have holding. So the idea is not to make any recommendation to buy or sell. And please keep this as a educational initiative only, right? So I'll just stop sharing my screen now. And Tushar, I've unmuted you and I'm also making you the presenter. So now you can share your screen and over to you.
Right. Thanks so much, Ankit, for the opportunity. Thanks everyone who's joined in or who will be watching this video later. It gives me real pleasure to do this for Mission Smile. Ankit is a very dear friend, though we know each other only for last maybe 3-4 years. But I really respect Ankit's thought process, and the admiration is mutual, Ankit. And it's been a lot of learning from you. I've seen a lot of the stuff that you do for your for the audience and for the people who are joined with SmartSync, and really appreciate the service that you're giving to the investing community. And it's really a joy to be on this forum today. I'll just quickly share the just 1 second. I'll just share. Just give me a second. I'll just share the document.
No problem. Take your time, Tushar. So while Tushar is sharing the presentation, I'll just like to share with all of you. So one of our common friend introduced us, yeah, and then from then on we just kept on talking about different stocks. So Tushar, you have already shared your screen. I think you need to share the presentation. So your screen is visible now, but you need to share the presentation.
Yeah. Can you see the presentation? No, I don't think so.
Not yet. So when you share, there will be an option of sharing there will be multiple options, whether to share the presentation or share a particular tab or share the whole screen. Go for the presentation one.
Yeah, I think it should be visible now.
Yeah, now it is coming up. Yeah, you can probably make it on slideshow mode. So that way it will be better. Yeah.
It's now perfect?
Yeah. Perfect, perfect.
Right.
Go ahead.
Okay. Guys, so we'll go straight into the presentation. I think the disclosures, etc., have been done. And, so let's set a context to how my investing career began, because it also has implications to how I think and how I try to differentiate my thought process from generally the followed concepts in markets. So I switched over to investing about 10 years back from a career in consulting. Now, as probably some of you would be aware that in consulting, your entire thought process is internal oriented. Whether you're working with any corporate or you're working with any strategy, the idea is always inside out. You're more worried about what to change within the organization, and therefore there would be an outcome, would be some kind of a number, an improvement in revenue, or reduction in cost, improvement in profitability, the organization becoming more efficient. But the thought process is always inside out. Whereas in investing, the thought process is always outside in. That is, you are always more focused on the outcome or the numbers, not as much on the what's happening within the organization to really affect those numbers. So that is where for me, to start with, it was a survival instinct. It was a survival strategy to really try and think differently, to bring over my sort of capabilities from consulting and try and apply them from to markets, to investing in general. And over a period of time, I realized that essentially what I did at consulting was very much complementary to what I have to do as an investor. And the idea is basically to really understand what the business is about, to make it really very simple. One of the key challenges to investing today is that you have businesses which are conglomerates, multiple business segments. You have a lot of moving parts to each business. There's a lot of news flow, a lot of diverse opinion and perspectives at all time. And amidst all this noise, and we are all connected with several WhatsApp groups, including a lot of non-markets related groups, where you still end up getting markets related messages. So there is a lot of information around us. There is no dearth of information, no dearth of complexity. What is really required is original thinking, having your own perspective. And that is where no, that's my first learning from my last 10 years of investing. It is not about how much you know, it is about really getting to the crux of the business, really knowing that one thing, why you're investing in a given company. So let me just take with specific examples. Let's say, I take four examples from four different industries, or rather five or six examples, to really bring home the perspective. Now, uh, say for example, something like CCL products, right? Now, it's a coffee is a complicated business. It's a multiple value chain. Globally, you have the coffee producers, you have the roast and ground coffee makers, you have the instant coffee makers, you have different brands. Now, where does CCL fit in the value chain? And what is the perspective? What is the perception on the business? Now, what I really invested in CCL, or the key reason why I liked that business, was essentially that everybody perceived it to be a commodity business. But what I saw within that is that CCL retains IP for over 200 different types of blends. So irrespective who they supply to globally, it is not the counterparty or the client who determines the blend of the coffee. It is CCL who retains that IP. So essentially, what is perceived as a commodity business, it's actually a lot of IP, a lot of intellectual property sitting in the business in terms of intangibles, in terms of your understanding on coffee. And with this is the understanding that they are now leveraging through their own brand on Continental Coffee. Be it something like Tata Elxsi, right? Tata Elxsi is again IT services has done well over the last couple of years, but Elxsi has been a standout performer. Uh, it's not a business which is very well understood, to be frank, and it's not a business which is very widely tracked, even within IT services. Now, the if you look at Elxsi and there are 50 other options to choose from in IT services, it may be difficult for you to differentiate one company from the other. But where I really think Tata Elxsi has a right to win is the fact that it's not just an engineering R&D, ER&D IT services company. They have a design element which is best in class, a design element which a lot of their peers don't have, competition to, and that gives them a clear right to win and ability to keep entering new business segments, and which is what they've done. From being perceived as a single domain automotive focused IT player, they are now present in 7 or 8 sectors and counting. The design element is now being very clearly brought out in presentations and in conversations by the management as being a key enabler, key strength for the company. And this is something that I had a view 5 years back. When I first looked at Elxsi, the first thing that struck me was that this company has a very clear right to win in the segment that it is operating in, a right to win which most of its peers don't have. So everybody will continue to grow, but whether Elxsi can continue to get a disproportionate market share or be able to gradually increase its hold in the industry, that is the bet I was taking on. So it was a very, very simple thing. Obviously, a lot of work goes behind qualifying that thought process, but inherently the thought process is very simple as to why you are investing in a given company. Once you have your core thought process in place, it becomes easy for you to track that over the years. It becomes easy for you to decide whether the company is staying true to the philosophy with which you had invested, and it also allows you to tide over the volatility. So likewise, very quickly, a few other examples mentioned. We were one of the early investors in Electra. We invested it 5 years back when it wasn't EV wasn't even a discussion topic within the investment community really. And the single biggest thought process was at that point is that for hardly a 100 or 200 crore market cap, you're getting this company erstwhile known as Goldstone Infra. And the bet was that they had collaboration, exclusive tie-up with a global leader in EV industry, BYD. And BYD had a more than a 15-year journey to EV, end-to-end entrenched in the value chain, and you are getting an access to that capability for an exposure of mere 100 crore, 200 crore market cap through Electra. That was the bet we were taking. And obviously, the other thing was that while there can be hundreds of players in two-wheelers and three-wheelers, because it is very easy to build a prototype and put it out in the market for a two-wheeler or even a three-wheeler. But to really put a full-fledged end-to-end bus together, a lot of technology challenges. The product, really needs to come together properly, and no government or no client would really pass it very easily. So the entry barrier is very high. The investment required is large. There's a bit of understanding of the domain that is required for you to really have a full-fledged EV bus, and you wouldn't meet the strict stringent criteria of government regulations to really pass muster. So that is where the view was that there will be only 4 or 5 companies that will really penetrate this market, and it is a large market. It is a B2B market. So if your product is established, through tenders, you can very quickly establish scale here. And that was always the bet that this company, there is a huge upside optionality in investing in Electra. Granules likewise perceived to be a commodity business, but let's say their top product paracetamol, it's more than a 1200 crore brand, 1200 crore product today. It is not easy to build that kind of scale, and as we shall see later in the presentation, that this it is not just the scale, it is also the profitability in these so-called perceived commodity products that really makes these businesses stand out. IRCTC, I think the very simple thing to really build home here is that is there a path to growth, which was the biggest concern for investors when the IPO came. It is a very cheap company, but it is only a ticketing company, and where the growth will come from. And as we shall see later, there I have been able to establish through my thought process at least 15 or 20 growth levers for this company, which will obviously play out over the next 5-7 years. So the first point, as I said, just to quickly bring home, the idea is to, whenever you're evaluating any business, the idea is to make it very simple, to have a very clear understanding why you're getting into it, what is the core concept behind this business, and what is the outcome that you expect to achieve over a given period. Very closely linked to this is a point that what is the objective of investment, right? Whether you are looking to really have a tactical investment, whether you're looking at it as a 3-6 months, 1 year opportunity, or whether you're really looking at it as a long-term 10-year, 15-year journey. Now, one of the things that I have realized is that, and this is how the human mind works, right? Behaviorally, if I tell you a stock that I think can give you 15% return in the next 6 months, or say a 20% return over the next 1 year, you will hardly be excited, right? If I tell you that a stock can give you 20% CAGR over the next 20 years, a lot of people will jump at the opportunity. So it is easy to take a decision on a 20% CAGR for the next 20 years, that yes, it's a very good investment. It is very difficult to convince yourself to invest in a stock that will give you 20% return over the next 1 year. Everybody in the short run is looking for multi-baggers. A stock that can double in the next 1 year, or give you 3x in the next 2 years, or say 50% return in the next 3 months. Nobody is really looking to go the long distance. And even when people do subscribe to a stock with a mindset to hold on for the long term, it is very often the behavioral, the emotional journey that, where they break down, because businesses will underperform for periods in this journey. Stocks will do nothing for many years, and then overnight they will shoot up 2x, 3x. So they will cut you both ways. There are times when you will get no return at all for a long period, and there are times when a lot of things will happen and you will have a tendency to sell just at the wrong time. So the idea is that, whether you're really, and if some of you are into running, I'm sure a lot of people will be, you'll appreciate that, when you're running short distance, it's always a sprint, and when you're running a marathon, it's always an endurance race. So the idea is not to set the fastest pace up front. The idea is to run at a pace at which you're comfortable. It is the same with investing. With tactical investments, you're looking at a lot of return very quickly, but not to hold on to the stock. But with investment, and which is where, really we should be focusing on, the idea is to identify businesses that you can really stay patiently invested for many years. So again, the same point that we've discussed. Now, if the ideas that I am going to discuss today, these are all stocks that I have been invested for many years, either individually or at the firm level, or ideas which I intend to hold on for many years. So none of these are short term, 6 months, got rich and let's move on. None of these are that kind of opportunities. These are all stocks where we've built a mindset for many years of investing. Granules, we've the first time I identified this company through a screener was almost 9 years back in 2014. And it has been a very patient journey, really understanding the business in iterations over the years. And as the conviction built up, the investment positions have also been built up to the extent that we continue to stay invested. It's a large position for us. Disclaimers, it's not a buy or sell recommendation. And the idea is that we think there's a huge runway ahead for the company even 5 years from today. Likewise, CCL products, We had 10% of CCL in back in 2013-14 when I joined Reliance Mutual Fund. And this was incidentally the first stock that I really did detailed consulting private equity style of work in, and to take a view whether we should hold on to that position or sell that position. The stock was, I think, on today's price terms, something like 25 rupees back then, and it went up from 25 to 200 very quickly over the next 1.5 year, and we were able to hold on the strength of my work. But uh, while that was a specific point in time, the idea is that the work that the company is doing is relevant very much even today. And one interesting thing to highlight is that companies evolve over a period of time. You may enter a stock with a certain view, a certain investment philosophy, but you have to also be aware how organizations are shaping up over a period and what is changing, right? So take CCL as an example here. It wasn't when when I first looked at it, the opportunity was to really understand the perception gap between it being perceived as a commodity business and what it was, a leader in instant coffee processing globally. Outside of Nestle, they had the highest capacity globally, and it is a very, very capable management and a very clear thought process. But today, if I were to hold CCL, it is for a very different reason altogether. They have actually made the transition from being a coffee processor into becoming a brand. And now, the next 5 years, 10 years, the real opportunity is whether they can scale this up into a branded FMCG company from being an instant coffee producer. They've already taken the first few steps. They have set up their own brand last 5 6 years, very silently, without any over the top marketing, without any aggression. They built a brand, got it up to 150 crore. This year is the first year they've actually gone live with the advertising on television, and have started to really make the noise around scaling this up into a pan India coffee brand. It's already, this would be around a 200 crore brand in my view, and it can easily be 1,000 crore brand over the next 5 7 years. Yes, 1,000 crore brand, India and globally, because they have not just launched the product in India but also US and one or two other countries. But they have not just stopped at coffee; they've gone a step beyond. They are now also working on plant-based proteins. It's the second area that they've ventured out into, and I understand they're working on a few more product categories. So the thing is that if I have stayed patiently invested in this company over the years and been tracking it, then I should be able to pick up the nuance that it is no longer a coffee producer, it is or a processor. It is moving and changing gears into a very different industry, and therefore, what will happen is the multiples will change. The way the business is perceived going forward will change. But one thing that will not change is that the management is shareholder friendly. They have not diluted at all after listing more than 20 years back. The company has got all the key basics principles in place to really create wealth and distribute wealth. Tata Elxsi again, this is very very critical point to highlight. If you look at, if you track 50 sell side analysts in IT services today, there are more than 50 60 listed companies. There are a number of analysts covering the domain. I don't think Elxsi is covered by even 10% of the analyst fraternity in IT services. There is simply not enough work done on this company, and the only reason, one and only reason for that is because in the near term, next 2 quarters, next 1 year, next 2 years, this stock looks expensive on all time frames, and it has always been expensive to peers. And because it is expensive to peers, and because most people are looking for tactical investment opportunities, they will not be able to invest in a company like Elxsi. It is important to here to really uh, differentiate where I am coming from. What I look at, this is not a 2 quarter opportunity. What I am really looking at Elxsi is whether this is a stock that I can invest for 2 generations in. You heard me right. Whether this is a stock that I can invest for 2 generations in. Is this a business that can scale up? Is this a business that will be around and relevant next 10, 15, 20 years? The answer is very much a yes. A lot of people may not be aware. I started my journey as a business analyst in Tata Consultancy close to 2 decades back, early 2004. And at that point, TCS was, I think it was 2004 or 2003, was the year in which they hit $1 billion in revenue for the first time. After being more than 30 years in existence, 2004 was the first year when TCS hit $1 billion in revenue. Today, 18 years down the line, TCS is a 25-26 billion dollar revenue company. Their quarterly profits are more than $1 billion. That is the kind of scale they've achieved in the last 18 years. In rupee terms, the number is even more staggering. It was about a 5,000 crore business revenue wise in 2004. Today, it is more than 2 lakh crores in revenue. Today, Tata Elxsi is about 2,500 crores in revenue. Now, it is anybody's guess where they can be next 5 years, next 10 years, next 15 years. The only thing I am very sure of is that they will continue to grow. Why do I think they will continue to grow? Because I have, in my mind, been able to establish a very clear right to win for this company. The opportunity is large. The segments they are working in are all exponential. And we'll come to that, or maybe it is the time to really, take you through that particular point on LXC. So if you see, you know, the idea with Elexi was that what is the real, tenet for wealth creation? You need to have a very strong business model, corporate governance, balance sheet strength, and you need to have a very clear opportunity. And which is what I see in Elexi. If you this is a proprietary work. I had looked at 15-16 quarters of data, and really every single differentiated thought process that the management has highlighted they are working on for at least 2 different quarters. You picked that up into a single slide, and if you see every single exponential moving technology of tomorrow, Alexi is doing some work in it. Be it VFX, augmented reality, immersive reality, 5G, IoT, 3D printing, robotics, you name it, they are working in that domain. And self-driving cars, medical devices, patented technology. So there is a lot of work that the company is doing, and this is one thing that they have highlighted in all of their calls, that these are exponential disruptive technologies. These are still early stage technologies. 5G is not even really commercial in India today, only now starting to get commercial. Industrial automation is a huge step away. There's a lot of work to be done. Self-driving cars, I think we are just seeing the first prototypes today globally. Next 5-10 years, these cars could be ubiquitous, even in India. So these are technologies that will disrupt the way businesses run, and the way consumers experience things around them. And Elexi is one company whose stated goal is to benefit from disruption, to be on the right side of disruption. So the point is, can a company like this continue to win market share, continue to grow at a reasonable rate for next 10, 15 years, 20 years? And whether you can invest in companies like this and not lose sleep over it. So to do that, to qualify that, the one thing that I focused on was that, who's the management here. We are talking of Tata Group, which is one of the best groups in India from a corporate governance perspective and from shareholder friendliness perspective. At least one group where you cannot doubt their intentions. So, Elexi being a Tata Group company, the balance sheet is very, very strong. They will continue to throw incremental cash flow every year and continue to distribute that cash flow. So, so the company has right to win. The company has balance sheet strength. They will generate incremental returns every year and distribute it back to shareholders. And this is a kind of business in that you can easily invest for 15-20 years. So this is basically, and plus one more thing is that the nature of ER&D, services from traditional IT. ER&D services today are still more project oriented, but over the next 3-5 years, these businesses, as the technologies mature, these businesses will become more service oriented. So it's like, when you're designing the first mobile phone, when Apple came up with the first phone back in 2007, it was a prototype version they were working on. So they would ask the vendors to say, give their 5 best engineers, help them in putting together a phone that really can stand out in design terms. 10 years, 15 years down the line, today, Apple is working on 5 generations of phone parallelly. So the one most recently launched, the one that is going to be launched this fall, this year, the one that they're preparing for already for 2 years down the line, and so on. So what was a product prototype opportunity with 5 engineers business, today maybe as a continuous service engagement with 500 engineers from their ancillary players. So what the kind of complexity and the kind of work that is generated in a mere mobile, which is just a handheld device in that sense. Just imagine the kind of work that will be generated for a automotive for a self-driving car or for an electric vehicle of tomorrow, 5 years, 10 years down the line, when these cars become ubiquitous, when there will be multiple products and multiple generations of products that will be worked on simultaneously. So the idea in discussing this is basically, you look at the business, you identify what you're investing in for, and you take a multi-year view on it. Just one sec, I will. Yeah. So, the same thing again is with Electra as well, right? If you see, the starting product is an electric bus, but they can very well diversify into electric two-wheelers, three-wheelers, passenger vehicles over a period of time. They can get into battery management side, they can get into battery storage side, and even the electric bus, they've hardly delivered about 700-800 buses till date, or maybe 1,000 buses till date. But there's a real opportunity for this company to actually deliver 2,000 buses, 3,000 buses, maybe even 5,000 buses a year. For that matter, their new capacity that is coming up rather, will be about 10,000 buses a year. That is the kind of opportunity that the company is looking at. So next 5 years, 10 years, this could be a huge company. And at some point, if they add the additional, business capabilities tomorrow, if they actually get into passenger vehicles, who knows? 10 years down the line, you might be looking at the Maruti equivalent or the Tata Motors equivalent, in Electra. 10 years down the line. So I am not one to take a view whether something like this can happen 5 years or 10 years down. But is there an option? Is there an opportunity for someone like Electra to really get to, say, a 10,000 crore revenue over a foreseeable time frame? Absolutely, there is. And it's a very small business today, even where we stand. It's a huge opportunity, huge runway for them for growth. This brings me to a point that is very, very critical with people. I think this has been one of my biggest failures, frankly, personally, is the fact that, in our industry, it is said that it is very difficult to find a multi-bagger. By God's grace, I have managed to, you know, work on or invest in a lot of companies that have done very well over the last few years. I think the single biggest learning for me for last 10 years has been bet size. It is no use if you have a multi-bagger in your portfolio and it is 1% of your portfolio. Because even if it goes up 10x, it will not really it will not really affect you positively in the same way. But if your top five convictions, cumulatively have a, say, 25, 30%, 40% weight in the portfolio, and if they do really well, it is only at that point that you will really, where you really be materially fitted from the outcome. The the biggest issue with our industry is that people keep moving from one idea to the other, keep looking for the next opportunity. You and if there are people here who are seasoned investors, they'll be able to appreciate what I'm saying here. Every single conversation that you have with people around you, be it your Diwali meets, be it your conferences, be it in general, if you meet any person, they are always looking for the next idea, the next opportunity. What next? Nobody is looking at, okay, the one that you had highlighted 3 years back or 2 years back or 1 year back. Is there incrementally anything positive there? Can I add on to that? Should I build more positions there? The idea is always to try and find a new multi-bagger rather than to try and build weight over the same stocks. And no, this happened to me. I identified a lot of good businesses. I was not able to really invest the kind of capital I should have. For me also, investing is a journey. It's a learning. It's only last 10 years, but even that, I think really last 2 years, 3 years, that I've really sort of picked up on a lot of these points, having made those mistakes in the first few years of my journey. So today, I think one of the things that I, as a philosophy, have identified and really have tried to lock in on a philosophy is an approach called systematic investment in your high conviction ideas. It's like how you do an SIP in a mutual fund, right? As an investor, rather than trying to time in, whether this quarter I should buy or sell, the next quarter will be bad or good, rather than doing all that, you know identify businesses for 5 years, 10 years, 20 years, and then every single opportunity, every single volatility, you should look to add, so long as the your original thesis on the company is not materially changed. So I am doing this. It's not a recommendation for anyone else to follow, but I think this is an approach will do really good if you can imbibe in your investing style, is to have a systematic investment in your top conviction ideas, or in ideas which you think could be good investments over a medium term, where you think that you can stay invested for 5-10 years. And therefore, say something like an Alexi, I am happy to buy at 10,000. I am happy to buy at 7,000. I am not worried that it has corrected 30, 35, 40% from the top. I will not even be unfazed if tomorrow it goes up very quickly another 20, 30% back, and that I have not been able to add to enough. Because now what I'm looking at is, I'm looking at this as a 15-year, 20-year journey. Can I add, say, whatever your comfort may be, 1 share, 5 shares, 10 shares, 20 shares? It may be a basket of securities that you want to build on. But can you continue to, at every opportunity, incrementally add to positions in stocks where you are very convinced on a 10-year, 15-year journey? So that is the approach I am incrementally following in my own investing career. I have systematically started to build positions in stocks that I think I want to stay invested in, which I would like to hand down to, let's say, my kids 10 years down the line. So bet sizing and the ability to systematically add to positions is a very critical learning. Is something that I have actually, has been a huge opportunity loss for me, not having understood this earlier. But there's still enough time, I'm sure, to correct on this. And this is learning that I can easily hand down to you guys. The fourth thing, and this, I think I have benefited from trying to think differently, trying to be less numbers focused, trying to have a different perspective to stocks. It has allowed me to think anti consensus. And that, I believe, is one area where multi baggers often, can get spotted. If you are looking in the direction everywhere else is, it is very rarely that you'll find a multi bagger. Because, understand, one of the key reason stocks become multi-baggers is not just the business growth. It is because there is a change of perception. There is a re-rating of the stock. The re-rating of the stock can only happen when the stock gets discovered by consensus. So if you are a part of the consensus, the discovery has already been made. And therefore, very rarely will you find opportunities that you will be able to participate in momentum and still make a lot of returns very quickly and over the longer term as well. So that is one point I wanted to highlight, that the genesis for long-term investment ideas, the genesis for consistent return and for a multi-bagger is in trying to think different, trying to think original. I think I have highlighted this already, but to reiterate, if I was to look at Tata Elxsi the same way that all my peers are looking at 2 quarters, and what is the near-term growth and what are the volatility, I would miss out on one big point, is that this is a business that benefits from disruption. It will be around 10 years, 15 years, and where a lot of money is to be made. So I had to think differently from consensus to really zoom in on this one. I think this is a better example to take now. IRCTC, right? I mentioned this earlier that uh, the biggest concern with markets is to really look at the growth levers in this organization. So what I did is rather than trying to understand the nitty gritties of the business and how the business model works, and you know, I took a step back. I just decided one thing: 10 years down the line, do I think the opportunities for IRCT will be manifold from what it is today, and what can drive the growth from here? And then I just took a pen and paper. I highlighted every single growth driver that came to my mind, and I put it up all on one slide. This slide is, by the way, from my TIA conference March 2021. That presentation is available. It's there on my Twitter handle as well. And if anyone wants to separately reach out to me for this, happy to share. Right? So I just put together everything on one single slide. And if you see, let me take just one example for growth drivers in IRCTC. Most people think that train ticketing is already well penetrated. 80% of people almost are today already using IRCTC as a service. So where the growth will come from? Now, people are aware that dedicated freight corridors is an infrastructure project under works for like close to 10 years now. What DFC intends to do is it intends to separate your commercial trains from your passenger train lines. So you will have a dedicated corridor or a dedicated route only for commercial freight, and the existing railway lines will get declogged and be used by passenger trains. Now, this initiative, I think we are very close to this being live now. I think next calendar year we'll see the first route in DFC already opened up. Now, just a simple exercise in logical thinking, you know, if and most people, let's take an example that you understand, right? If you drive down to Lonavala, or if even in city, the biggest challenge is traffic, is congestion. When you go down the road in peak traffic, and one of the biggest culprits for peak traffic are actually the large sized vehicles, which often break down at the wrong point at just the wrong time, or narrow lanes. You have a large vehicle coming in, or more than one vehicle coming in, then even your high speed cars get the speed gets determined by the slowest moving vehicle in the corridor. So it doesn't matter you have a Mercedes or you have a Rolls Royce or you have a Honda. If the car ahead of you is moving at 10 kilometers an hour and you have no way to overcome or overtake it, then your speed also gets determined by the same measure. What it means is, in terms of trains, if your freight train is moving at an average speed of 30 kilometers an hour, and the passenger vehicle behind it can move at even 100 120 kilometers an hour, but if it does not have a clear run, then by default the track's capacity is not getting fully leveraged, because your trains are running much slower than what they can optimally run at. Now, as soon as you remove the 30 kilometer an hour vehicle ahead of you, you immediately open up the corridor, you speed up the corridor. And as soon as you speed up the corridor, more pockets of gaps get created in the entire corridor, which allow you to introduce more services. What it means is that by simply removing and creating a separate channel for the commercial freight trains, you will create significant incremental capacity to add passenger trains, and your existing trains will also get faster. And by this itself, as per my calculation, could theoretically open up anywhere between 30 to 50% incremental supply opportunity over the next 3 years. That is the kind of one-time injunction that will come from just one variable on this sheet, which is DFC. There are 20 such levers. Whether it is ability to hike convenience fee, whether it is ability to scale up the water business, whether it is the initiatives that they're doing on e-catering side. Again, a very interesting way to look at is, if train journeys today, right? When I was a kid, it used to take, let's say, to go to my hometown in Rajasthan from Bombay, the journey would have been maybe 20 hours. Over the years, that 20 became 18, then it became 16. Today, it may be 14 hours or 12 hours, depending on where I'm going. By the time my kid grows up, that 14 or 16 may actually come down to 7 or 8 hours, maybe even lower than that. So the capacity is always getting created through incremental efforts in what government is doing with railways, right? They are introducing better trains, newer trains, faster trains. Your overall experience is going up, so you have now more AC coaches than they were there at our time, and the number of dedicated AC trains has gone up and going up by the day. So if convenience fee is a metric, the convenience fee is higher for AC coaches and definitely higher for AC trains overall than non-AC trains. So the growth will come. The growth will come from multiple such levers. One more thing is that, if you were asked to take railways food, the perception of railways food is poor quality, average quality food, and you are not going to, even if you have to buy, you will not willingly pay more than 50 100 bucks for that, but you will pay 500 bucks for your favorite pizza. And today railways allows you to get pizza from Domino's on board on the train at specific stations. So because they have a revenue share agreement, IRCT, it does not matter to IRCTC whether you take a 50 rupee food or 500. They will take 10% of that, let's say. But if you take a 50 rupee food, the revenue to IRCTC is only 5. But for a 500 rupee pizza, the revenue to IRCTC may actually go up to 50. Or even if that the sharing comes down, it will still go up to 25, 30. So, in absolute terms, there is a huge revenue growth potential for IRCTC, which is something that will be visible and play out only over a period of time. They have recently opened up budget hotels, and they are working on multiple such initiatives. They've recently converted payment gateway, which was a cost to them, to a revenue line item. They now got permission from RBI to become a payments gateway aggregator. So the idea is that once you understand that the growth is not a challenge, you can really take a 10-year view for this company, and suddenly, what appears as expensive in the next 6 months, 12 months, from a 10 years out perspective, what is an 800 crore profit business today? Can this be a 5,000 crore, maybe 7 8,000 crore profit business? The answer is yes. For a 5,000 crore profit business, what kind of multiple will it get? High ROE, no need for incremental investments, a continuously high dividend paid up. What kind of multiple can this business get at that point? So that is the idea. The idea is to think differently, move beyond. Let's take one more example here, which is granules, right? Just one sec. The biggest challenge with granules is people perceive it to be a commodity business, saying यार पैरासीटामोल बनाता है, पैरासीटामोल में क्या पैसा मिलेगा? But बॉस पैरासीटामोल में 30% मार्जिन मिल रहा है. They are getting a 30% ROC in paracetamol, maybe even more. And they are creating a scale in that business that is difficult to replicate. If today Granule shuts shop, is it something that someone can come up with a paracetamol plant 25,000 metric tons overnight and get the quality level and get the cost level which Granules has perfected over 20 years? Is it possible for someone to replicate it in 1 quarter or 2 quarters or even 1 year? That is the kind of question that you need to ask. And that is where you have to be anti-consensus. The consensus is that it is a paracetamol maker and it does not make money because the margin in paracetamol may be 15%. But the important point is they are operating at scale. At that kind of scale, when you have a very clear understanding that you have to keep producing a single tablet on and on and on a certain amount of size, right? It's a well-oiled machinery. Even 15% margin still gets them 30% ROCE, but the margin may actually be slightly higher. But so what I did was that I tried to break down the gross block or the capital invested in by Granules into two parts. One is capital that has gone into their core molecules: paracetamol, metformin, ibuprofen. The top three molecules where their combined revenue today is probably upwards of 3,000 crore or close to 3,000 crore, anyways. So these three molecules. Then this, by the way, I have taken these slides as is from my different presentations. I have a presentation available on Granules, is available on my Twitter handle as well, which I had presented at the India Investing Conclave in August 2021. So in that, I know what I tried to do. I had tried to divide the capital invested into core business and the new initiatives, which may not yet be to the level of optimization. And again, it is here that you need to understand Granules is not looking to come up with a new molecule and make three quarters of profit before the molecule becomes commoditized. Granules is trying to enter a commoditized space, and by virtue of creating large scale, high quality, and a very, very efficient cost structure and consistency of quality, they are trying to gain market share and disrupt a so called commoditized space. So, some of their new initiatives will, over the years, start achieving the same kind of ROC for them, which the core business is already doing today. So once you divide the business and really go down to understanding at that level, it will become evident to you that paracetamol, metformin, and ibuprofen combined, you know. So let's just take the numbers here, right? FY21 3,200 crore revenue overall, of which 2,700 crore was essentially the top three molecules, uh, on a gross block of 1100 crore that is directly attributable to these three molecules, and maybe a couple of hundred that is newly set up but not yet being optimized, not yet in use. So 1100 crore gross block is giving you 2700 crore revenue. So suddenly you look at the asset and is actually much better than what is visible in the consolidated numbers. An EBITDA of 700 crore is possibly directly attributable. I have given my assumptions how I have arrived at those numbers here. So it's not something that is like a publicly available information. It is a logical deduction from publicly available data. So 700 crore EBITDA, about 600 crore EBIT on a 1100 crore gross block, and a 1000 crore working capital. You can do the math in terms of the return on capital invested that they are being able to generate from the core business. The bigger point here is, and that is where the idea to be long term oriented and anti consensus is the fact that this kind of business at scale cannot be replicated overnight. If at all it can be replicated even over a period of time. People are happy to pay 50, 60x multiples to branded business, to FMCG businesses in India. But a scale oriented pharmaceutical reasonable ROC business is trading at a multiple of 10 times next year earnings. Whereas some very average businesses in a lot of other sectors are trading at anywhere between 25 to 35, 40 times of next year earnings. So that is where I see the opportunity, and I have stayed invested in this business over the years, seen management walk the talk. I am happy to be invested next 3-5 years, so long as the thesis remains intact. And I think there will be a point in time where these businesses will get much better rating as the real strength in the business starts to uh, be perceived. We've discussed CCL already. This is a very, very much related point to uh, to the previous one, but the way to highlight this is, so let's say one of,
Sorry, I am interrupting you, but I
yeah,
think CCL also, that slide is important. If you can go through that slide, because you just made a passing remark on CCL. If you
okay,
can
fair
cover
enough.
that slide,
So let me cover
that
it then.
yeah.
So this is in a nutshell, why when I was first asked to look at CCL, why I inherently took a liking to this business. Global leadership, they were at 10% ex Nestle Global Coffee. This is 2014 slide that I'm using. That 10% has today moved to much higher, in my view. It's a large commodity, global commodity, and CCL has got a very clear, step in the entire value chain. It's a niche and highly profitable industry and very high entry barriers. You think whether someone would want to replace CCL, with another manufacturer or processor, and take a risk on that blend effect, change of blend affecting, one thing, and I think there would be a lot of tea lovers or coffee lovers here. People adapt to a specific taste in different markets. Even in India, the coffee that you get in North is very different from the coffee that you get in South. Be it chicory based, or be it aggregation based coffee, or a freeze dried coffee. The subtle variations in taste do affect the adoption of coffee, even in a single country like ours. But when you look at the cultural preferences globally, more than 200 countries, uh, there is definitely something that a large client of CCL, who's relying on CCL to give them consistent quality and a specific blend every time, will they want to risk for saving 5% or 10%? People have tried, moved out, tried to go to a competitor or to a lower priced option, and have had to actually come back and come back at a premium back to CCL. That is the kind of inherent strength in the business. But the other point was that the company continued to consistently grow capacity over a 20-year period. This is back to 2014. Again, I'm saying over 1995 to 2014, they grew capacity more than 10 times. And so at that point, the business was not getting the real multiple. And we shall see in a slide later how, when people started to appreciate the real value in the business, the stock went up close to 10 times in just 1 year. And that is where the re-rating happens. That is where your multi-bagger comes. If you are early of the market, or if you have got ability to build view on a specific stock or a specific company where the market may have not reached that level of thinking, and once consensus reaches that thinking, is when you will make your money. Of course, again, I reiterate, the reason to invest in CCL today is very different from what it was in 2013-14. Today, I am looking at CCL as a possible branded FMCG player over the next 5-7 years, with 1,000 crore plus brand sale potentially. Whether they achieve it, anybody's guess. But whether they have the right to win, whether they have got the right team and capability and intent, I think hands down, all of that is already in place. So the point on this is, so let's take example from two examples from our fund, one where we have benefited and one where we have yet to benefit. you know so I think HDFC Bank is a near consensus. If you ask banking stocks, HDFC Bank in all time frame is the supposedly the best quality bank in India, right? But if you look at from our perspective, last 3 years, SBI and HDFC, State Bank of India and HDFC are two of the largest banks out there, right? They are, in terms of size, in terms of visibility, they are two of the most visible banks. Every single analyst who covers banking and financial services in this country will have an opinion on both. In two well discovered stocks, when the consensus has always been HDFC, SBI has hands down outperformed in the last 3 years, and it may not continue to outperform, going forward. I think HDFC may be well placed from this point forward. But the idea is that by just because HDFC Bank is the consensus, you happen to think that okay, it is easy to make money, and you put all your money behind a stock like an HDFC Bank, or maybe some of the leaders in other segments, right? So let's say an Asian Paint, for example, or one of these leaders in different categories. Just because it's a consensus buy, or everybody seems to be bullish, does not necessarily mean it will make money for you. And to that extent, I think one stock where uh, being a part of the consensus has actually not helped us is this stock Bharti Airtel. I think, last 3 years, last 5 years, with the advent of 4G, Bharti saw one round of re-rating. We've been bullish on the stock ever since the 4G thing started to play out. But if you look at, post COVID, if there was one industry which was supposed to be hands down winner because of COVID, IT, but more importantly, it was telecom industry. Sitting at home, data consumption is shot through the roof, many-fold. Businesses need to be better enabled on telecom wise. It's a clear consensus that ARPUs have gone up and will continue to trend up from here also. The number of players have shrunk. Bharti is the leader in the industry and continues to benefit. Obviously, Jio has disrupted the industry, but today, essentially, it's largely a two players and two half players market. Bharti and Jio being the two players, and Voda and BSNL possibly competing, in specific markets, but not really mainstream pan-India competition anymore. So it is essentially boiled down to two real players in the industry, and ARPUs are going up, data consumption is going up. It has become B2C as well as B2B requirement to be fully, upgraded on telecom side. One would think that Bharti is hands down a winner. It has to be part of your portfolio, and indeed it is a part of our portfolio. And yet, the stock has underperformed market for 2 years now. And all this while it has been a consensus investment bet. And it is very much likely that just as you start to lose patience in Bharti and institutions start to sell and it starts to move off the consensus list, is possibly the time when it will really give you another momentum rally from here. So, Loris is one example, a stock where we invested, and it's been a great winner for us, and is a well-known, discussed stock. Uh, we started doing work on Loris is also an example that what you see at the point of explosion or exponential return is not the point at which the journey starts. Loris, we have been patiently tracking, studying, investing time into understand the business and to understand the management philosophy and thought process since the time it got listed in 2017. The time came for us to really, benefit from that learning and capitalize into an investment move. It happened in early 2020, and even we were surprised by the ferociousness of the rally thereafter. The stock went up 3x in 1 month from our point of investment. But the point is that I'm trying to highlight, at that point, Loris was not even close to a consensus choice. In fact, API and CRAMS as a business was nowhere close to consensus 2.5 years back when we first became bullish, or rather 3 years back when we first became bullish on that space. Say late 2018, early 19 is when we turned bullish on the mid-size pharma and API and CRAMS related opportunities. And what happens is that that same Loris outperformed significantly, and then everybody started to talk about it. Today, if you look for one Twitter thread, you'll get 10. If you look for one expert, you'll get 100 on the company on both sides. People who can highlight the positives as well as the negatives. But it has become in many ways a consensus stock, a stock that everybody tracks. Whether they have a position or not, everybody is keen to discuss on this company. And therefore it has actually not done that well over this period, because as a stock becomes widely tracked and discovered and widely discussed, expectations are also become materially different, and a lot of players come in with short-term orientation. People who have seen the stock move up 6x 7x in the last 1.5 years and think that it can move up another 1x in the next 3 months 6 months quickly are the ones who actually enter last and who actually spoil the market, who are the ones who actually lead to the volatility in the stock. And this also puts pressure on management to actually try and cater to that kind of segment and end up complicating by wrong guidance, maybe, to take a specific example for Loris. So coming back, consensus rarely gives upside optionality. There will be exceptions to this, but if you are looking at if you are looking at really standing out as an investor, then your starting point must also be different. Your starting way of thinking about businesses and investments has to be very different, and you have to stay true to your philosophy no matter what, and even through periods of underperformance. I think I have sort of touched upon this already on the point on optionality, but let me highlight the theoretical construct here. My own personal investment philosophy, and to a large extent my our firm's investment philosophy, is rooted in optionality. That optionality can come in multiple ways. It is not a vague or esoteric term. Optionality means something that allows you to create disproportionate returns, something that leads to a disproportionate jump, or in the outcomes. And how that will happen is, a so if you really want to achieve this, now you have to uh, alter the rules of the game. One way to play optionality is to look at a very different time period, which I explained, rather than looking at 2 quarters or 4 quarters, or maybe 2 years. If you are able to play an investment over 10, 15 year, 20 year, the long time frame nature of investment gives you one level of optionality. A second level of optionality is when organizations are able to deliver consistently earnings better than expectation. And this need not happen throughout the entire journey. But even if a stock, let's say, has 1 or 2 or 3 years of consistent outperformance to consensus, to the expectations, that is where the re-rating will set in for the business. Which brings me to the third lever and most important lever of optionality. PE re-rating is one of the most important levers for optionality in our markets. The flip to side to that is essentially what people say as value focus. When you buy stocks which are value focused, you buy low PE stocks. The idea is that there could be a PE re-rating that will benefit from. But I personally am not so much fixated to just low PE, but I am fixated to the idea of optionality in the investment outcome. So there are a lot of businesses where I have personally invested in, or where as a house we have invested in, where the idea is that there is an inherent strength in the business which people don't understand or perceive today. That strength we are able to catch hold on by our proprietary work, by our ability to go further deeper and take a differentiated perspective. Once you've understood uh, what is the real gap in perception, where between what market thinks that business is and what the business actually is capable of delivering, when that gap is bridged, there is a sharp and ferocious re-rating that generally happens. And that re-rating will not happen over 6, 8, 10 quarters. That re-rating typically will happen over 1 quarter or 2 quarters, or 1 month flat. That is the kind of disproportionate returns we seek in a lot of our investments. We seek uh, so let's take examples from uh, so let's take the example of CCL products, right? What happened in that 1 year period, 1.5 year period between 2014, late 2013 to early 2015, the earnings did not went up 8x or 10x. The stock went up 8 or 10x because the PE multiple got re-rated, because people started to understand and appreciate the point of view that we had held from day one, is that this is not a low margin, low value addition commodity business. This is a high value addition, difficult to replace, high entry barrier business, which will continue to scale up and then continue to consistently deliver returns over a period of time. Once people move to that understanding, the stock got re-rated instantaneously. In case of Loris, what happened is, you take 2019, I think they did 90 crore PAT. 2020, they did FY20, I think they did 250 crore or 230 crore PAT. If you go through the con call of those periods, management had very clearly highlighted that they are investing in capability building. They have a lot of fresh gross block, fresh capacity addition that is not yielding any returns. In fact, that is a drag on the business. So even when they had, let's say the year they had 90 crore PAT, they had possibly anywhere between 50 to 100 crore expense only on new capacities which had yet to yield any revenue and which was being fully expensed out. 1 quarter of delivery into FY21 and the stock got entirely re-rated in just 1 month flat. And that was the year when the 250 crore PAT moved to close to 1000 crore PAT from in FY20 to 21. So the PAT definitely went up 4x, but it went up over 4 quarters. The stock got related after just 1 quarter performance, and the stock actually went up far more from the lows of late 2019 or early 20. The stock is actually up more than 10x or 12x from that point today. So that re-rating when it happened was ferocious. IRCTC, if you look at the re-rating that happened, ferocious. And let me take that first. So let me just jump quickly to what I'm trying to highlight. So if you see CCL on this, that the left corner, in a flat line in 2013, and then there is a sudden pivot in 2014-15, and the stock went up over a 1.5 year period from 25 rupees to close to 220 to 30 rupees in a very short period of time. IRCTC, again, this was the time, the left bottom of the screen is when the stock got listed. It went up very quickly, it came down again, and then it gave a lot of time for you to do differentiated work to really understand the business before it went up, in like uh, in just 2 months flat. The stock went up from say 1500 rupees to close to 6300 at the top. Obviously that last leg of it was momentum fueled, and maybe the stock is corrected equally sharp, but it still is significantly up from the point of first movement in post COVID. So the idea is basically, when the optionality plays out. So what we are looking at in a optionality is ability to identify, to build a perspective on the business which is not consensus, which is not something that the way people are thinking. Let me take one more example from an idea is not covered here. Uh, let's say two businesses, one where we invested in the IPO recently, and which is recently got listed, and one where we tried to get a anchor but we could not. uh, the first one is EMIL, Electronic Smart. I think fantastic business. The stock has the company has actually grown revenue 8 times over the last 10 years. From a 500 crore revenue in 2014, or last 8 years rather, they have 4,300 crore revenue in FY22, and great brand, fourth largest electronics retailer in the country. A very simple to understand business once you understand the key thought process. uh, I am taking a bet here that this stock can continue to deliver very good numbers in the next 2-3 years. But of course, with a strong listing, whether there is an upside optionality, I don't think so. So the stock may deliver with execution, but the optionality is to an extent covered for in the listing gain. From here, the optionality will be whether this 4,000 crore revenue can over the next 5-10 years go to something like a 20, 25, 30,000 crore kind of a scale over the next 10 years. If that happens, then this would be a high revenue, high profit, large cash throwing out company, and the multiples will get re-rated even further from here. The second business, Paras Defense, you know, when I evaluated this company for the IPO, it was love at first sight for me. And not because the stock was coming cheap, but because the way the promoters built the business, the vision that they had to really, build this business out. If you look at for a, I think the profit was hardly 10-15 crores when it came for the IPO. I think last year they did something like 25 or 30, somewhere between that number. But the level of management capability and bandwidth that they have built in that organization, if you just look at the expertise that has been built up in that organization, tier 2, tier 3 management, below the promoters, it's fantastic capabilities they've built, the kind of investments they've made upfront to build this business out. But the more importantly, the kind of work that they're doing in drones and anti-drones, which I think will be a huge, wealth creator in the next 5-10 years. A lot of companies will create a significant shareholder wealth that are able to tap these technologies well. And I see a very clear right to win for someone like Paras Defense. They've got one of the top government, scientists to become a co-promoter. They have invested in him, and he in turn is building this business out very, very beautifully. Some of the partnerships that they have already struck are global in nature. The global manufacturing types. It's all disclosed in public domain. You know, so So let's take one example of a partnership which I think people may not appreciate today, and that is where the perception or the perspective differences. One of their collaborations is a company for drone parachutes. Now, today, even today, drone is a rare sight. It's not that you see one every day. But if you go to a marriage, or a party, a lot of the photography started to get done by drones. So that is probably where you might have seen most of people I might have seen actually a drone. But at the other end, at the cutting edge of technology, drones are fast becoming a mainstream solution for a lot of different activities. Drone based weaponry, drone there are a lot of wars that will in future be fought only over drones. uh, Drone has got significant applications from logistics perspective, from agriculture perspective, from border security, perimeter scanning. There are a lot of niche applications that are being built. So what I think is going to happen eventually over the next 5 years is that drones will start becoming ubiquitous. And once they start becoming ubiquitous, once you start seeing them every day, is the point when you will actually uh, sense a very different threat. Is the fact that drones starting to become a issue for snooping, right? And more importantly, you could have a drone falling out of the sky. It may have just the battery may have died down, or it gets hit by a bird or some other object, or and you may have a drone falling and uh, you know something falling from the sky on your head, and it's not a pleasant situation to imagine. It could even lead to a calamity at some point. So like it is with a lot of flying objects, like it is with planes, there will be a lot of safety measures that will come up. There will be a lot of program management that will have to be done, a lot of logistical planning that will have to be done. Drones will come under certain protocols. It will not be that anybody can fly a drone at any point anywhere. So you'll need to have a proper UAV management program, unmanned aerial vehicle UAV management program. So two of the collaborations that Paras has, one of them is with this company that is a global leader in UAV management, UAV programs, which I think is going to become a solution requirement eventually for all drones across the globe. Their second collaboration is this drone parachute company. Now, when drones become ubiquitous, I think it's a matter of time because before every single drone is required to have a parachute system. Meaning, if the drone, for whatever reason, if the battery dies down, if the power goes out, or if the drone gets hit by an object, there has to be a compulsory mechanism by which the drone, has a parachute system, so that if it is falling down, it does not fall on someone's head at a high speed. So this is basically something that will play out next 5 years. And this company has already thought through about it and already has a collaboration in place for global manufacturing for a concept like this. This shows how far ahead in future they are thinking in building this business, and how well networked they are, and good understanding of technology and government regulations they would have, that they are able to actually build a business for many years ahead of time. Likewise, they are doing some very, very interesting work on anti drones. Uh, I think it will become evident over a period of time as these businesses start to scale up. But the way I was looking at for this company in the IPO was that it was a 500-600 crore market cap at the IPO stage. And I think both drones and anti drones itself can become 1,000 crore revenue businesses at a certain point in time in future. So you're talking the base defense business, can it be 1,000 crore? Answer is yes. Can drones and anti-drones be 1,000 crore? Answer is they can be much more than that possibly. So you are getting a company for 500-600 crore market cap, which let's say over the next decade can be possibly a 3 to 5,000 crore revenue company. Then whatever the profit and whatever the multiple you may want to apply to that. So the idea to highlight these businesses, and obviously again disclaimers, there's not a recommendation to buy or sell, and you should do your own homework. But the idea is to highlight that you identify optionality in these businesses and bring down your return expectations. What happens if something like Tata Elxsi does not give you that thrust for the next 20 years? Can it continue to grow at 15% CAGR? very much yes. If the stock is expensive today, can that 15% PAT CAGR translate to say a 6 to 8% or maybe 10% price movement CAGR from here? I think an 8 to 10% price CAGR is very much possible. Does an 8 to 10% return excite you? I don't think 90% people in this forum, in fact, even 90-95% investors will not be enthused by an 8 to 10% CAGR stock ever. But if you have to allow optionality to play a role, the downside is that the base return will never be guaranteed. You will never have a stock give you 20% CAGR in base scenario and an optionality of a 30, 40, 50x on the upside. So the base return expectation always has to be moderated, you know, and that is where, this is my favorite style of playing investments. I cut down on the return expectation and I compare it strictly against what I will get with the bank FD, and I expand my time horizon to a level which other investors cannot match. So as soon as you cut down your 25-30% CAGR expectation to a 10% plus optionality CAGR, and indeed the optionality will give you maybe much more than 25-30% CAGR if it plays out. So the moment you cut your return expectations to very reasonable and your time horizon to very long, you are allowing yourself the ability to benefit from that disruption, from that optionality. And that, I think, is the crux, the sum and substance of my investing philosophy personally, and also something that we as a house attempt to emulate. One thing, I think it is very, very important, and we mentioned this point on bet sizing, right? Now, it is not that if you have a high conviction on that stock and you still don't have a large bet, it is not always a case that you have not acted. A lot of times the problem is you think you have a lot of time, because stocks, for long periods the stocks or companies do nothing. No, you will have let's say 6 months, 12 months, 18 months, a stock will do nothing. Let's take a very good example, which a lot of people hold personally, is this stock ITC. There have been jokes around it to no end. That ITC would be pivoted around the 200 rupee price. I think it was pivoted around that price maybe for 2-3 years, maybe more. Today, silently, that 200 has become 350. And if you were waiting for to buy ITC, that okay, it's every single day you look at it is around 200. Complacency sets in. You think that I have enough time to do research, to identify and understand this company, and in 5 years I think it will make a lot of money. But I will time it. I will try to buy it just at the point of explosion. But if the stock continues to move up gradually, with every 5%, 10% move, it will be 10% too expensive for you. You will want it to come back to the price at which you had originally anchored your expectations. But rather than coming back, it moves up another 5-10%, and then it moves up another 10%, and then one day it will move up 30%, and then you will never be able to invest in that stock. Because we think there is a lot of time, but when it comes to execution, markets are brutal. More often than not, you will never get the time. Let me take some specific examples. BSE, my thesis was anchored in BSE on two things. I first looked at this company when it was hardly 1,500 crore market cap, 1,500, 2,000 maybe. The idea was that there is room for two exchanges to be in the country. BSE has been a leader. NSE today obviously is the number one exchange in the country, but BSE would continue to be around. And if you are betting on, like people have bet on, on the domestic retail participation in markets. If you are betting on markets overall, you cannot not bet on the exchanges. So it was always a no-brainer. But the stock did nothing for a very, very long time. And one of the key tenets for me was to, the reasons to me to invest was that I always felt that as and when the NSE IPO happens, BSE would get significantly re-rated at that point. And therefore, there would be a point of inflection when you will get to buy. And what's happened is last 3 years, there's been a lot of noise around NSE IPO. The IPO is nowhere close to happening even now. But BSE has silently continued to move up to a point where it is already 4 or 5x from the point at which I first looked at it. And I never got, let's say, time to build positions personally to the level that I would want to be comfortable with. Same thing happens with stocks. Let's say IRCTC. You this kind of a move up that you see in the chart pattern, it is very difficult because you think that the stock will come down, correct, the profits are not going to move up overnight, and therefore you will get time to study the business and invest. But the stock rarely gives you time once it starts to move up. The move up is, and look at Tata Elxsi. It comes, boils down to being the top conviction that I had all these years, and yet when the stock moved up significantly, I was caught short with the kind of position I personally wanted to have, simply because it did nothing for a very long time, and then a 500 rupee stock, at the onset of COVID, went up to 10,000, and once it moves up the first 20-30%, it's very difficult for you to build large positions. And this has also been the critical learning, which brought me down to the thought process that no longer will I try to time my investments. I will try to rather uh, continue to invest gradually, irrespective of the price. If my horizon for a stock is 20 years, it does not matter what the price is today. In a 20-year time frame, it will still be a blip. And therefore, the better thing to do is to keep investing every month, every quarter, every opportunity that I get in every correction. So in fact, while people who may have invested this in this stock at 10,000, and a disclaimer, I have investments even at that price personally. For me, for someone like me, I am actually salivating at the opportunity that the stock is giving me a 30-35% correction from the top, allowing me to get to build incremental positions much cheaper.
Tushar, I can, if you allow me to come in here, because I have a very relevant point here regarding this SIP thing which you are discussing, and which I believe many investing market participants don't pay attention to. So, like we all have heard about the story of Infosys stock. If you'd have bought Infosys in 2000 at the height of the Y2K mania and held on to the stock for 8 long years, you would have made no returns. So what Tushar is saying is not that you buy at the top and just hold on to it. He's saying incrementally buying at all prices. And you can go back and check that exercise with Infosys. Even if you would have started investing in Infosys from the point of that March 2000, when it was available at something around 200 times P, and you would have kept on the SIP every month for the next 8 years, your XIRR in Infosys, where you started at the very top point, would have been in excess of 13%. And if you can get something like an Infosys or a Tata Elxsi much earlier, like what Tushar has done, so he's not investing only at the top. He has been investing since 2018, 19, 20, right? And you just keep on building on your position. That gives you a completely different result compared to what people perceive in the market, right? So sorry, Tushar, I just wanted to
No, no,
make
it's
it
a
clear.
very, very welcome interruption, and a very valid point, Ankit. And again, no, guys, I must reiterate that this is not about one stock. This is not about one sector. A lot of people here know we have multiple investments in pharma. I can give you 10 examples in pharma that would fit the bill today. But I can give you examples from 10 other sectors. The idea to do this exercise today, to pick up 5 or 6 examples from different sectors, and these are all stocks that with a long term mindset. The idea is that there is no right or wrong approach to investing, but my personal learning, and I think Ankit also does this very beautifully, is that he does SIP, which he did not mention, but he is actually a proponent of this theory himself. The idea is that you identify any company. Behaviorally, one of the biggest challenges for us is to, when you identify something that you think will do really well over the next 20 years, right? The first thing that comes to your mind is that I have a lot of time. The stock will do well over 20 years, or this is a 20-year investment. So even if I don't invest today, let me make that money elsewhere, and I will come back to this stock 2 months down the line, or 1 month down the line, or 2 days down the line, and I will invest that return from another stock, and I will take a larger position in this stock, right? What happens is, let's say you invest in a, let's say you had let's say Paras, right? Let's take a different example. Let's say Paras today at 650 rupees. It has moved up 4x from the IPO, from 175. It went up to 1300, is corrected 50% from the top. Depending on how you look at, there's a lot of correction already done, but there's a lot of fraud probably already there. So it is very much possible for you to take a view that this 650 will come down to 500. That is the optimum price to invest. Or for another investor to think that this 650 may continue at these levels for 1.5, 2 years. And at the point of inflection, I'm happy to buy this at 700, 750, even 800. But I will rather save that money, invest it in another stock at a different point, make returns there, come back and park it back here. What happens is that the stock doesn't know that you already own it or you don't. It has a journey of its own. Just because the stock has been available at 650 or thereabouts for the last 6 months does not mean that it will be available for the same price next 6 months. For all we know, this 650 may come down to 300, 350, 200, maybe 100. Who knows what it will be 6 months or 1 year down the line? It may very well be possible that this stock may go up to 1,000, 1,300. It may go to a new high. It may be 2.5, 3,000 in the next 2 years. The idea is not to try and time the point of entry, but rather focus your energy on the stock, on the investment philosophy. Once you have identified a business, I'm not saying, let's say you want to build position for 1,000 shares in something like Paras Defense today, right? You don't have to start with 1,000 today. But there is nobody stopping you from starting with 5 shares, or 10 shares, or 50 shares, or 100 shares, depending on your comfort. And there is nobody stopping you from adding every 5 shares every month, irrespective of the price. That way, if let's say 6 months down the line, this 650 becomes 300, you will get an opportunity to invest at 300. You're not letting go of that opportunity. If for some reason, God forbid, this 650 goes to 1,300, you have not been able to buy sufficient, you at least have a position. You will at least be able to participate in some upside. And it allows you the ability to buy something more at 1,300 or 1,000 or 1,100. Rather than starting from zero, you might as well start from having some positions. That is the objective. And see, again, behaviorally, if you have zero quantity of a share, you have zero emotional attachment. The moment you buy even one share of any stock, an emotional attachment starts, a journey starts. Your tracking becomes better. You'll start to follow that stock more in conversations. Any messages around that, any information, insights around that, you'll be able to pick up and filter better. So once you have even a small position in what you perceive is a possible investment, it allows you to participate in the conversations around it and to benefit. And as you iteratively get better and your conviction improves, it allows you to do your bet sizing over a period of time. So bet sizing does not mean table thump on the first moment and buy everything. What it means is that you are able to gradually build positions in the stocks where you want to build positions. You have not missed out on the opportunity because of failing to act. Anyways, so a lot of such examples. We haven't discussed NOSIL much. I'll just, in closing comments on NOSIL, say this, that the inflection point for NOSIL was, and that chart is not here, probably it'll come later. The inflection point for NOSIL was anti-dumping duty in 2014 or 15. When there was an anti-dumping duty set on rubber chemicals. But the journey for the company had actually started much earlier, about a year and a half earlier. There was one quarter, and you can look back, it's publicly available data. There was one quarter when the margins bottomed out at 1%. Yes, 1% EBITDA margin. It was that quarter when the company was at make or break. It was that quarter when the Dahej plant came on stream. And from that point forward, the company never looked back. And if you were tracking that sector or segment, or if you happen to track that point of inflection, you had a year and a half to build positions in NOSIL before it significantly started to move up. And then once it started to move up, it went up very quickly. In I think 1 year it was up 8x or 10x from that point. The stock gave you time, but whether you acted on it and whether you understood that point of trigger was not the anti-dumping duty, it was already passed. So because we had some understanding or some tracking of that sector and the company, we were able to pick that point of inflection. And when anti-dumping duty happened, we were able to take an investment decision very, very quickly, that okay, it makes sense now, because the business is turned around, it's a survivor, things can only get better from here, and suddenly there is a trigger on the positive side that will make things much better. So the point is that you need to catch these inflection points well, and not assume that you will get enough time to build positions. This is this I think is not just applicable to stocks or investing. I think this is a very, very universal applicability, is the concept of return on time invested. Because money can be earned, and eventually as we grow, we'll have more and more of it. So money will never be a constraint. Always the constraint will be the bandwidth that we can devote to identifying specific stocks. That is where I think one of the biggest learnings and one of the biggest benefits I've had in my personal investing, and even when I invest for the house, or when I'm thinking ideas for the house, I think one area which really gives me a lot of comfort is that not every stock, not every investment, you need to invest the same amount of time. In a portfolio, if there are 20 stocks, not all 20 will be 5% candidates. 5% of the portfolio. There will be few stocks that will be greater or lesser, and not all 20 stocks you will need to spend the same amount of time. In fact, if you look at in your own portfolios today, there will be one or two stocks where you need to do disproportionate effort to stay on top, and there are one or two stocks where you have actually absolutely no understanding or clue of the business. You have possibly got lucky, or you were told by someone very well connected, or very well very insightful, and an expert in the domain, that hold on to the stock, and you held on and you made money. So on one end you have opportunities where you have zero efforts or very little efforts and have made money. On the other hand, you have stocks where you've invested years and years of efforts, and the outcome is not to be seen. So therefore, I define this as a very important concept in investing. Identify stocks. In fact, in your whole investing process, find ways to create that disproportionate upside through limited efforts. Find ways to cut through the noise, to cut through the jargons, to cut through the complexity of the business. Find ways to create. So basically, it's like lifting a car. Because if you don't have that jack hammer, or you don't have the tool through which you lift up the car effortlessly, you will actually have to physically lift up the car, right? That is an effort you will have to put up. It's a disproportionate effort. So you have to apply the right levers to bring down the effort, and to create a larger opportunity on the upside. So way I do this is I try to first bring down the complexity of the business. I try to break down the business is to really what is the simple concept behind that business, really what is the underlying philosophy of that management, and what is the vision, and what is the principal reason I am staying invested in in any stock. So uh, I would love to give specific examples here. Maybe I'll just come back and give you one or two. But the biggest problem that I personally face today is how to allocate my time. Right, we are all connected in multiple groups. I'm probably close to 40 groups related to markets and otherwise personally, and I'm sure a lot of you guys may be facing similar issues. A lot of information overload on a daily basis. There is multiple data points to be tracked, and for each business, for each company, and a lot of other noise as well. Amidst all of this, the hardest thing to do is to make a simple perspective of why you are investing in a business and hold on to it. So I will come back to this. As I said, I don't probably just need to think through a specific example to highlight. Now, one of the beauty of this market is that it constantly throws up opportunities. So, the ninth and 10 points are very related, which is basically A, are you prepared for volatility? Now, when markets correct, is your first thought, to identify ideas to table thump and buy? Or is your first thought that, I have got stuck, or I am not sure what is there in my portfolio, or let me sell and get out first? So, are you panic selling or are you table thumping buying? That is the difference, whether you're prepared for volatility or not. And the related point is, it is that volatility that always gives you a second chance, whether you choose to take it or not. If you are prepared, if your work is done, if your conviction is in place, and your conviction will not there for every stock, but at least it has to be there for a few stock, for a few opportunities. When you have your conviction in place, you are actually able to benefit from that optionality, and it is actually in these times that the return is made. The return is not made in good times chasing momentum. The return is made in times of volatility by buying when the world is selling. So I will take specific example. I think this is one of the most beautiful examples to take from my personal investments. Electra, we were very early in identifying Electra. We have been invested in the, if I could actually put it around, in the point of first inflection in that mid 2017 year. It was around that point when we first identified and really took an investment position in this stock. In fact, Electra is possibly also a very good example of ROTI. You know, Let me give you an anecdotal example. Uh, you know, I and another friend investor friend, we had a very detailed call with the management in Electra, and the outcome of that 1.5 2 hour conversation was that we decided that we should probably do more work on this company. It looks very interesting. There is possibility that there could be a good investment opportunity here, but we penned it down to saying that okay, there are few clarifications. We need to observe the company for a few months, and then we will go and see the plant, talk in more length with the management, and then decide what to do. So it was basically, अगर मैं सिंपल वर्ड्स में बोलूँ, पंचवर्षीय योजना थी कि हाँ मिलेंगे, करेंगे, देखेंगे, वी विल गेट द टाइम, और अपने तब डिसाइड करेंगे. And then since the CEO had come to meet us, I told him that you have to meet Madhu boss, at least 10 minutes, at least let's get introduced. And Madhu, my partner and boss, he precisely asked only 4 or 5 questions. I still remember that vividly. It was 4, maybe 5 questions is all he asked. 10 minutes is what he took to decide on investing in Electra. 10 minutes is all he took. And it's not to say that we did not do due diligence. We, in fact, did many, many months of diligence thereafter. But the principal decision, the handshake happened in, or decision to spend time and effort happened in 10 minutes. I vividly remember it was a Friday. Madhu told me this looks fantastic. Let's work right away. You take the next flight tomorrow morning, and go and see their plant. And the the CEO was not even prepared for that, and he was like, sir, I am traveling this that. So Madhu said, okay, no problem. Monday morning, let's come and see your facility. And Friday we had this meeting, and Monday morning I was at their plant. And by Monday afternoon, I had already called up Madhu saying that this looks very interesting. I think you should come down and meet them. And Tuesday, Madhu was in their office. And in principle, Tuesday was when we decided that we would invest in this company. And it is at that point, and from there, we did 6 months of due diligence, by the way, before we actually invested. A lot of things happened around the management, around the company. there's a lot of history to Electra, but we waited until we were absolutely certain that we won't lose our money and that this company will survive for the long term. But the first incident was very quick. The second thing is that once having decided to invest here, whatever work we've done only on the theme. There is no real work to be done at the company level. It's a very clear opportunity. There's a very clear execution path. There is not much that we need to do or we need to track. There are only two or three variables really need to track to invest in this company. But because we were early and because it was still a concept and only the first buses had got launched then, there would be a 2-3 year journey before that translates into an execution opportunity. And that is where I come to this point of second chance. You look at 2017, from where the price moved up, and you look at 2020 post COVID, the stock was exactly back to that same point 3 years down the line. What had changed was only one thing. 3 years back, Electra only had a collaboration with BYD and a prototype bus that had got very good response. 3 years down the line, they had a full-fledged business model, team in place, change in management, a stronger management had come in, capital invested, or the company had capital to deploy. They had a very clear business plan and vision. And what was a on paper document with BYD had translated into a 3-4 years of collaboration with demonstrated execution on ground. And their product had got very, very strong feedback and continues to sort of get so while the price had come gone 360-degree, rotated the entire world and come back to the same level 3 years down, the business was very different. Our understanding of the business was very different, and our ability to hold through that volatility should have been very different. That is the point, that if you are prepared, volatility will give you a second opportunity. If you are not prepared, then you are very likely to actually sell at the point of at this second point of dip, and you will never make money in these stocks. Because whether if you are early to the party, there is volatility to be had. If the markets are bad, external situation, there will be volatility. If the business is still untested, the execution is still unproven, or early stage of execution, there will be volatility. You cannot beat it. And there is volatility due to a lot of externality. Only thing you can do is identify which businesses to add and which to subtract in periods of volatility. And that, if you are able to do well, you'll be a different investor altogether. So I think I have one more that I would like to highlight, which is very recent, is granules. You know, if you look at the stock between FY18 and FY21, 135 crore PAT has gone up to 550 crore PAT in FY21, more than 4x in 3 years. And yet people continue to question its execution capability and doubt. And a lot of people actually thought that maybe the numbers are linked to COVID. And I'm sure that the company will disprove this eventually through focused execution. In my view, they had a bad last year. It was well communicated to the markets. There's very clear communication from management on subsequent con calls as to what went wrong. They had issues in paracetamol supply chain, which affected 3, maybe 4 quarters of performance. They are, in my view, I think they are well and truly back on the journey of growth again. And this dip that you see in the last 6 months, last 1 year, to my mind, again, if you are well prepared and you understand the business, it's a buying opportunity. And if you're not well prepared, then probably it's a sell opportunity for you. And a lot of people may have actually sold at this point. So that brings me to the conclusion of of the prepared thesis. And I would leave you with this one last thing on NOSIL. If you see, Jan 2013, April 13 is the quarter, I think, when the Dahej got operational, and the company gave good 2 years almost before it started to move up. And then it was between 2015 and 17 is when the stock really performed well. I think 2015 is, or mid 14 is when the anti-dumping duty came. So you had enough opportunity when you decided to invest, and you look at post COVID, what happened? The stock retraced all its gains of the previous 3 years, and it almost came down to the point of inflection again. So that is where you had your second opportunity to invest in a company like Nosil. Very good management, very focused management, simple to understand business. They are leaders in a niche and will continue to remain in that niche, but do very well going forward. And I think these kind of businesses give perfect opportunity in volatile times to invest. So with that, I will come to a close. I had put in a lot of extra slides to highlight one or two of consequence. Let me run through. Uh, I had said about Tata Elxsi, the 16 quarters of reading and to identify the areas they are operational in. See, this is the kind of effort that goes into a simple solution. So let's say Tata Elxsi has their own IP. They have an autonomous platform, which basically does the integration of sensor inputs and is a decision making algorithm for self driving cars. So it is very much the heart or the brain of the car, right? To come up with a full fledged integrated platform like that, Elxsi would need deep rooted capabilities cutting across all these areas marked in green. You need to have understanding of virtual and augmented reality, immersive reality, because you are dealing with you're dealing with uh, a situation that is not practical today. You're trying to imagine or visualize a future 3 years, 5 years down the line, and prepare for it. And you do this only by these kind of immersive concepts, where you try to recreate those situations of the future and build the solution. So VFX, VR, AR, AI, and deep learning, of course, the algorithm cannot be a static algorithm. It has to be a self-learning algorithm. It has to take input from sensors and get better at integrating those inputs into a decision or an outcome over a period of time. So you need to have understanding of AI and deep learning. You need to have understanding of design philosophies, how these kind of algorithms will be built, what is the kind of solutioning that will be required, how these algorithms will interact with the other parts of the car, and how they will interact with the consumer. So there is a human machine interface, which I'm not marked here incidentally, but you need to have understanding of that element also. System integration is a very important part. You have to have an understanding of imaging technologies. A lot of the upgrades to these kind of solutions will happen over the cloud, so you need to be able fully on top of what are SOTA updates, right? So in putting together a solution like autonomy, you need deep rooted capabilities across 15, 20 different areas. And this is not traditional body shopping outsourcing work. There is a lot of intellectual heft that goes into building these kind of things. A lot of intellectual capabilities, a lot of IP that gets built up to build these solutions. Likewise, this is, if you look at the entire automotive capabilities, it's pretty much integration of all of these. You take a different example, consumer electronics. Tata Elxsi is working extensively with one or two large global consumer electronics companies. Panasonic is one they have revealed the name of in the past publicly. So they are working with Panasonic for their global lineups, next generation consumer electronics devices. Again, to build out solutions for this, you need capabilities of very different kinds. And, so so few people know, for example, that Elxsi has built the robot for Tata Group, which is used across in a number of their other corporates. The TAL Robo has been built by Elxsi. Uh, or the fact that the work that they're doing in experience design, for a number of same airports and metro stations and so on. So this kind of capabilities gets built over a period, and it's not easy to replicate. IRCTC, again, I had done a lot of work to really build out the revenue streams, and also how really, they own end to end of the consumer value chain. Granules, again, I will quickly run through one or two points. You know, for all the issues, perceived issues around granules, it has been one of the best wealth creators and one of the best PAT CAGRs in pharma mid caps in the last 10 years. Just look at 30 crore PAT in FY12, 550 crore FY21. This slide was done in 21. FY22, I think that came down to 400, slightly more, 413 to be precise. I think they should be able to cross that 550 this year. That's my estimate, and be onward to the growth journey from this point. But just look at the kind of wealth created over a 10-year period in this organization. They have one of the best track records in regulatory compliance amongst all companies. This the track record for some of their peers. You see mostly yellows and reds across the board. Granules is one of the few companies that has a clear track record with regulatory compliance. We discussed this slide on scale, and again, Granules is not the only company that is working on scale and on product leadership in specific products. You have enough examples from both chemicals, Vinati being an example, pharma, there are multiple examples, DVs, Laurus, IOL, Haikal, IPCA and Lusartan. There are multiple examples. Chemicals, of course, Aarti Industries, Atul, there are number of examples in chemicals where large scale in specific products and leadership. This is a very interesting point I had picked up from DV's FY22 Q1 con call. This really is the crux. Just look at a typical example. If you look at our history, just read it out. Either with gabapentin or naproxen sodium, dextromethorphan, all these products. Some of them we are the 20th one to enter the market, but we became 60 to 70% market share leaders. So they entered 20th in the ring. If you have observed wrestling at any point, this is like King of the Ring, boss. They were the 30th or the 20th entrant in the field, and they cleared out the competition to become the leader. So this basically it's created over many years. This is not an overnight phenomenon, and that is why I like some of these businesses, because once this kind of a scale is created, it is hard, if not impossible, to replicate or replace. And this again example, lot of leadership. I think since then Clean Sciences had got listed, global leadership, Ather leadership in specific products, Sudarshan Chemical in pigments, Deepak Nitrite, phenol acetone, Gujarat Fluorochemicals in PDFE polymers, Vinati of course. So enough Tata Chemicals in soda ash. There are enough examples of market leadership, of large scale in specific products, and of aggressive capex. And therefore, I think that there is a lot that we've yet to see in this industry. Plus, some point on how actual granules, profitability or productivity is better than peers. Asset turn is actually very good. Quality of debt is good. Very low cost interest. Working capital is not a challenge. Regulatory track record is good, and so on. And the fact that they have hands down been one of the best wealth creators in mid cap pharma in the last 10 years. So this is again one last point. I just look at the BII stake in Granules. This was 3% in 2021. There is hardly any institutional understanding or tracking of a stock like Granules, right? And which has been one of the best wealth creators in the past. There is hardly any domestic institutional ownership. Now, as this company grows, gets scale, market cap goes up, multiples improve, it is anybody's guess what this 2.86% DIS stake will move up to. I think it is up to 4.5% already today, and there is enough room for it to move up further. We have discussed CCL, so I'm just running you through sort of slides. CCL, one interesting point, and we have not spoken about this at all, is the fact that companies with low promoter ownership can also create wealth. CCL, promoter holding was very low at the point at which we invested, and it has continued to move up. It's about 46% today, but it went up in a hurry in the period, at which point their business scaling up was happening. And if you had tracked this, there's a very good opportunity to invest. I will highlight one mistake. I have on purpose not put it on the slides. I will highlight one mistake, from the past. Wockhardt was one of the first stocks I invested in. Took permission and invested in. when I joined with Reliance Mutual Fund. And work hard, I took a view that promoter has 75% holding in the company, and therefore interests are aligned with shareholders, and therefore wealth creation is eventually going to happen because the business side is good. They had come under import alert at that point in two of their plants. I took a view that import alert typically gets resolved in 1.5 to 2 years. Should likely happen with Wockhardt as well. A second assumption was that promoters, this business eventually will sell out, and too much stronger hands. That was assumption two. And third assumption was so obviously it's promoter holding is aligned, the interests are aligned, the resolution of problems will happen, and there's an upside optionality on the M&A part. And as we know, 8 years down the line, Wockhardt is still not been able to get the plant cleared. And despite that 75% promoter holding, Wockhardt has come down from a peak of 2,200 rupees to what, maybe 200 rupees today, 250 rupees. It's massive wealth erosion that has happened in the last 6-7 years. So a learning for me was that high promoter shareholding does not necessarily mean that you will create wealth in that company, and low promoter shareholding does not necessarily mean that you cannot create wealth in that company. Although you may have to work harder to ensure that promoter interests are, to understand and ensure that promoter interests are aligned with that of the shareholders. So this is one last, one bonus learning, Ankit, with your permission. One thing that I have not put up on the slide. If I can take another 5 minutes.
Yeah, please go ahead. Sure, all yours.
So, guys, I want to highlight this point that one of the biggest friends as well as enemies of investors is this, and companies for that matter, is this concept of leverage. I want to highlight the fact that we end up in volatile times or bad times. The biggest mess happens in scenarios when the corporate is extensively leveraged, so companies which have large debt, or the promoters are leveraged, so pledged holdings of the promoters, or promoters have exposure to multiple businesses, so their time is leveraged or their money is leveraged, right? So corporate leverage at a promoter level, and when our portfolios are leveraged, these three kinds of leverage can kill any business or any investment portfolio in a bad time. So if anything, this is one area that you should definitely work on, getting the right sized exposure in your portfolio and to the right kind of companies. In addition, while this is not really a leverage, but it's an example of borrowing from a period in time. A lot of corporates, even let's say a lot of fintech companies have got listed companies where there is no profits today, but 5 years, 10 years down the line, there could be huge upside. The biggest problem working with these investments is that in a bad market, in a bad situation, these businesses will not fall 5-10%. A lot of them will get decimated, and a lot of them will probably never recover. So if you are investing in these kind of businesses, get your understanding and facts right, and get your conviction steeled up, because you will face volatility. And we are indeed seeing a lot of so-called top quality stocks 50, 60, 70% down from their peak. Some of these may recover and move on to create new highs. Indeed, the new highs could be a multiple of where the original high was, but a lot of these stocks will never recover. So be sure when you're dealing with leveraged concepts, meaning companies that are getting multiples today for what business will get created in 2, 3, 5 years, 10 years time, you will see correction. In fact, indeed, some of my own investment holdings, where I have taken a 20-year view, but the stocks are expensive in the near term, they are getting corrected. I am prepared to actually add in those opportunities, but you should be able to do your own homework and decide whether to invest or not in these companies. Thanks. I will leave you with that, and with one last wisdom, that no matter what happens, not everybody who's heard me today, likely that 90% of learning will well be forgotten or may not be practicable or implemented in your own portfolio. Eventually, you will have to learn from your own experience. But I am hoping that at least some of you, or at least some of the points, will have benefited from my experience, my mistakes and my highs and lows. Thank you, and I'm open to questions.
Thank you. Thank you so much, Tushar. I'm 100% sure that, like me, everybody enjoyed the session a lot. So, Tushar, just before we begin the question and answer session, I just wanted to have a heads up from your side. How much time do we have? Because we have already past the original 2 hour limit. So based on, so I have all the time you can, but tell me how much time you have so that we can take up questions accordingly. Because I'm sure there will be many questions. I've already seen a few questions on the chat box. Then there are a few hands being raised who
So
will ask the question directly.
I'll try and answer as many as I can. There is no time
Okay.
limit, but let's take 30 minutes as the indicative. If we don't
Sure.
have enough questions, then we'll wrap up in 15. Meaning enough relevant questions, we'll wrap up in 15. If we have, then I'm happy to continue. Boss. No problem.
Sure. So before we begin, one last point which I mentioned at the start of the presentation. No stock specific questions, please. I've also mentioned in the chat, there are a few stock specific questions which we'll avoid. You can ask anything related to what Tushar has covered today in the presentation, or you can talk about themes or sectors. So I'll start with the chat box first, and then we'll take up the questions. So I probably take next 10 minutes or 15 minutes from chat box. And in the end, then we'll take the questions from the hands being raised. Okay, so let me just start with the first one. So Gopi Krishna Reddy is asking, what is your views on the domestic pharma sector? Keeping in view of price increases by regulatory authorities coming into play from last quarter onwards.
You mean domestic formulations, right? Branded formulations.
I guess so. Yes, I also believe that. Mhm.
So I think domestic pharma is excellent franchise for the long term. We understand that India, all said and done, the Indian pharma market is still only about, in somewhere around that 17, $18 billion market today. Maybe 20 billion thereabouts. Certainly not more. Uh, as the country matures, as the per capita GDP moves up, healthcare spending is only going to go up, and a lot of the spending is also because we are still a very young population. A lot of lifestyle diseases will happen with age, with over a period of time. So a lot of chronic therapies will continue to see very very strong growth. Unfortunately, health is going to be an area where we'll continue to have to invest as a nation, and individually as we'll have to invest. So I think it's a great opportunity from a 10-year perspective. The problem is that if you look at domestic pharma, most of the businesses already have seen one round of re-rating. So if you look at the leaders, they're anywhere between 25 to 35 times 1 year forward EBITDA. At that kind of EV EBITDA multiples, or at that kind of PAT multiples, you know you are pricing those businesses to be perfect on all time frames, which they will not be. So there will be some regulatory risk, some externality. NLEM prices have NLEM linked issues, or some generic drugs will come in, or businesses will over 1 or 2 quarters stutter, stumble, fail to perform. The idea is, if you're pricing the business to perfection, you will set up yourself for disappointment. And it is on in those periods of disappointment where some of these businesses, the reaction will be excessive on the downside, and you'll probably get very good entry opportunity. Can you invest today? I think you can still invest today in a number of businesses in domestic formulation. I like that sector. I think there's huge opportunity, huge runway with 10 years, but it is not a smooth runway. You cannot expect that last 5 years, the kind of consistency of growth will necessarily happen for all companies. And B, the optionality that I like to play. There is no re-rating optionality on PE multiple for the leaders and the large companies in this space, in my view, because they already got re-rated to a multiple from where further re-rating it may happen. That 25 EV EBITDA may move to 40 EV EBITDA. Eventually market is a exercise in behavioral theory. So you can't stop someone from buying at 40 times EV EBITDA. But whether it is logical to do so is the point. I'll give you one example actually, as an academic this thing. We were an anchor investor in Gland Pharma. Through one of the entities where we have an exclusive advisory, an offshore FPI. We were the anchor investors in Gland Pharma. And one of the key tenets for me to decide that we should invest was that there is a huge vacuum in large cap pharmaceutical companies. Vacuum in the sense where you have a very clear combination of top class management, strong execution, very good corporate governance, and zero regulatory issues. And multiples, also are reasonable. There is actually not even one company that I could say that is passing on all the parameters. DVs at that point came closest because they had no outstanding regulatory issues when Gland IPO came. In general, corporate governance related perception is reasonable. Regulatory, after the import alert that they got cleared in less than 10 months, it was a very, very, well placed from a regulatory standpoint. The opportunity still had a lot of tailwind. So, good theme, good execution, good management, regulatory wise comfort, and multiples, but multiples had already got re-rated substantially. Whereas the US led generics who are transitioning to specialty, Sun, Lupin, DRL, Cipla, all of them were in investment phase. Sun possibly being the only one which is looking clear to transition to the next level. So there was a vacuum. Mutual fund industry had 1.5 lakh crore invested in pharmaceuticals, of which more than 1.2, 1.3 lakh crore in the large cap, where they have actually not made money over a 5-6 year period. So they would have been looking for good change, and Gland Pharma at that point at the IPO level had zero negative history to it, had a good corporate governance. The corporate governance perception was good. Regulatory wise, they were very comfortable, no issues. Business had good growth opportunity, and it was a stock perfect institutional ownership candidate. And so that was a very, very simple behavioral exercise for me, that there is no way that this stock will not get re-rated post listing. I speak from hindsight benefit, but to be frank, that was the thesis upfront, and that was also the thesis on which I have discussed this with multiple peers in the industry, where I told them that I think you should also look at this stock. So, you know, so it was an expensive stock to many at that point, but it still had re-rating possibility. The same Gland Pharma at the same price today again may not necessarily give the same return opportunity, because now there is a bit of negativity attached and associated to it, right? Someone has invested at 4,000, at 4,500, maybe at 3,000, 3,500, and the stock has actually come down. So there is a built up history to it now, and so therefore it may not necessarily get re-rate again at that same pace. But there was an opportunity in Gland which we actually capitalized on, and uh, we made it was a very good outcome for us, if I may just say so. So yes, to answer that question, it's a very good 10-year opportunity. It will be not without hurdles. If you have the stomach for it, you can start buying today and you continue to buy through volatility. But don't expect immediate re-rating potential in some of these stocks, at least not on the domestic pharma base. The re-rating may happen more from a US business perspective, if at all.
Thanks, Tushar. So, Tushar, I don't know whether you have looked at a few caustic soda players. So, I think
Sorry,
Aditya.
caustic soda.
So Aditya is asking about your views on caustic soda industry and commodity sector as a whole, as to how do you look at, specifically when we hear things like China plus one, Europe plus one. So, what is your view on
So,
that?
see, I think, it is hard to play a commodity stocks like with like a structural upside. But if you are to play commodity stocks in cycles, they provide excellent multi-bagger return opportunities. But it is the idea is, बस अगर मैं हिंदी में बोलूँ ना, the biggest challenge is इसमें अभिमन्यु बनते हैं. Most of us enter with half knowledge or half understanding, and don't know when to exit or how to exit, and you end up getting crucified. So if you are able to get your entry and exit thought process right, you will never get the full extent of the upside, but you can easily make 3x, 5x, 10x even in a lot of these stocks. So in with that as a caveat, I think you have to understand that, let's say, some of these commodity chemical companies, or the segment that you mentioned, there is definitely a challenge in Europe, and there is definitely an issue with China. And to think of it this way, अगर अपना धंधा है, if you're doing business, and tomorrow one of your suppliers, for whatever reason, घर में प्रॉब्लम हो गया, कोई पर्सनल इशू हो गया, या उसके प्लांट में आग लग गई, या कोई पोल्यूशन का इशू हो गया, एंड इफ द गाय शट शॉप फॉर इवन 3 months, right? And that product was say 30% raw material cost for you, you would have made 20% margin in that product, value addition करने के बाद, because of the supply issue with that particular vendor. You had to buy that product 20% or 25% more expensive for someone else, right? And you couldn't buy enough, so you actually lost some revenue and you lost some margins, and the guy may have a genuine problem. एक बात बताओ, when he goes back to normal, and in the meantime if you built up an alternate supplier, will you shut down that alternate supplier कि नहीं यार अब मेरा वो पुराना बंदा वापस आ गया है, तुमने खराब टाइम में मदद की, थैंक यू वेरी मच, अच्छा लगा मिलके? You will never do that, right? You will say that okay, let me transition some business back to the previous guy because uski bhi galti nahi thi, but some business you will continue with the new guy, so that tomorrow if another situation like this happens, you are not completely cut out, boss. If you cut that second guy today, he will never come back to you again at the time of your need, or he will squeeze you out. So you are forced to build a second supplier because your first supplier has shown vulnerability. And what happens to individuals happens to institutions and to countries also. If China as a supplier has shown vulnerability or has shown, strategic arm twisting, so they've at the wrong time they've shut down plants for pollution control, or have tried to take a geopolitical advantage out of a supply situation. When you are suffered with that kind of a situation, you will never go back to 100% reliance. It's a pure behavioral logical thinking. You will never go back to that person. Likewise, what's happening with you with Europe today? If your energy cost, and commodities generally are energy intensive industries, you need energy is a very important part of the cost, and generally commodity oriented businesses will be low value addition businesses. So your margins are, you're working with wafer thin margins. Any escalation in one cost item can actually disrupt your business model entirely, which is what is happening with Europe. So if that kind of a situation happens, once an industry gets disrupted for any length of time, and I'm not talking 1 day 2 day, right? You can what has been on for not like 8 months now, or maybe more. When this kind of a situation happens, it's like a slow death for the industry. The industry will never go back to the same level. And even if they do go back, the overall scale will be maybe 3x, 5x higher. So there is definitely some business that will go away from Europe. What will happen is, in the short run, few companies will face disruption on their products that they were supplying to Europe. तो हो सकता है कि revenue खराब भी आए for one or few of these companies. And on the other end, they may get some disproportionate long-term opportunities in business also. Like we are hearing from a lot of the investee companies, they are seeing very interesting opportunities come up in discussion because of what's happening in Europe. And Europe, I think energy disruption is very real, very valid. It may, even if it gets resolved today, the people who are looking for alternative will not, go back entirely to Europe. So I think, specifically, I think you mentioned caustic soda, right? I think there is a lot of disruption happening. Near term, I see good potential in some of these companies to move up. Over the medium term, cyclical hai, so it may move up, say maybe 30-50%, 1x, 2x, maybe specific companies. I don't see a permanent opportunity, but there will be some permanent benefit to these companies from the disruption for sure.
Thanks. Thanks so much, Tushar. So, in the interest of time, I'll not be able to take up all the questions. So, I'll just take last two questions maybe before we move on to people who have raised their hands. So, I think one question is interesting. Avdut asks, I would like to know if Tushar starts from scratch today, how he will study the pharma and chemical space to get hands on the sector and select good companies. I think this is a very interesting question. So I took that up because that will help all of us over here.
Because we are every day starting from scratch here. Unfortunately, there are so many disruptions in this industry, in this space. You cannot rest on your laurels. You cannot rest on past winners. right? In fact, last 1.5 year, pharma sector has gone nowhere, and chemicals also has not really outperformed meaningfully, right? And the arbitrage between chemicals and pharma continues. Pharma is much cheaper. I think what is important in sectors like these is to build up some viewpoint on specific pockets of the market. Like, if I assume I have zero positions today, if I were to look at the different spaces, domestic branded formulation, very good business, very the only one real disruption that can happen is the generic products coming through, because the government is trying to promote low cost medicines. That is a very real disruption possibility, but I think it will play out only over a period of time, and not all companies will get disrupted also, but the multiples will come down because of that. And that is the only thing back of my mind. Otherwise, if I am able to identify any company here that can continue to grow at a 15 to 20% CAGR next 10 years, I am more than happy to start position building today and gradually build up positions over a period of time and use dips rather than momentum to buy. Likewise, I think diagnostics is a very, very interesting area. You are seeing diagnostics get disrupted. Multiple new players are coming in. A lot of existing players are tying up with large corporates, or getting bought out, and therefore there's a lot of disruption happening in this space. But I think there is a huge growth potential. Even today, the best of case, average individual gets diagnosed maybe 2 or 3 times, not more, a year, right? You can very well move to a preventive healthcare system where you get diagnosed every 15 day, 1 month, from a chronic disease perspective, or just to be on top. If you can get a package that allows you to get diagnosed 10 times a year for a 50% higher cost than what it is today, I'm sure most people will take it. Ankit, I think it's a problem at Ankit's end, but so I will identify one pocket at a time to answer the question, and I will then form a view on that pocket. Then within the pocket, I will look at whether there are companies that allow me to do two things: A, play the earnings CAGR, and B, play some kind of a PE multiple re-rating possibility. I will maintain API and CRAMS. There are still enough opportunities to do that. On the branded formulation side, there are a lot of smaller companies that where there is still that opportunity. On the US generics, I don't perceive a lot of opportunity, but specialty, I think leaders like Sun Pharma, etc., yeah, there's a possibility to play. So I will identify those pockets and then take a fresh investment view on specific companies in those pockets. And I must say there are enough opportunities in pharma and chemicals both even today. If you have a 5 year mindset, maybe more.
Thanks, Tushar. So uh, there was one pick
Ankit,
over
I
that.
can't hear you.
So
If you
I
just be
think,
a bit louder.
can you hear me now, Tushar?
Yeah, better.
Okay. So Tushar, so there was another question related to diagnostic, which you have already covered. So we'll move on to the people who have raised their hands. So I think Dr. MP Bajaj has raised his hand for a long time. So I've unmuted you. You can go ahead and ask your question, Mr. Bajaj, Dr. Bajaj. Yeah. Are you listening?
I am
You have to
not able to
unmute
hear.
yourself.
Yes, now it is. Tushar, thank you very
Yeah.
much. Ankit, thank you very much.
Sir, I can't hear you. Unfortunately, there's a problem with my network. You'll have to be just a little bit louder, please. Or Ankit, you'll have to relay the question to me.
Okay, Tushar,
Sure,
thank you
sure.
very much. Ankit, thank you very much for giving me the opportunity. I want to know the sectors you are looking for 2023 and for next 3 to 5 years.
Thank you. Thank you so much. Yeah. Tushar, did you get the question or shall I
No, please
repeat the
relay. I am
question?
not able to hear.
So, Mr. Bajaj asks, which are the sectors you are looking for, you are bullish on in 2023 and for the next 2, 3 years or 5 years? So, if you can talk about some
So it
sectors.
is difficult to take a 1 year view, to be very frank. But if I look, say, 5, 10 years out, but even let's say from a 3 to 5 year perspective, I think you'll continue to see a lot of interesting investment opportunities in banking and financial services. There is one large area, and it is very much related to the economy. So banking and financial services, I think there is a lot of opportunity. Uh, I see, defense and this entire manufacturing related theme. There's a lot of opportunity still. I would not go to specific defense companies, and I know a lot of the companies have moved up sharply. So I'm sure that we'll have to probably wait for some dips, or start adding gradually. But the way to look at this is that, you know from being from reaching a position of self sufficiency in defense, which also will take a few years. We are actually looking at defense as an export opportunity, and manufacturing as an export opportunity. So these are structural themes that take many years to play out, and the benefits are accrue over many years. So if you are able to identify one or two good companies in this space, and related, I think cap goods and engineering services companies, there is a lot of opportunity. I think you should continue to see momentum in some of these. I like automotives as a theme. I think auto has had 2-3 years of trouble globally. There was first muted demand situation, then a lot of disruption in the industry. I think the entire auto component industry is undergoing a level of disruption right now. Then the third thing is that COVID and post-COVID complications did affect the industry. Then there was the semiconductor supply chain, and now the issues with Europe and inflation issues globally. So there's been back-to-back 2-3 years where auto, we've not seen full, like auto has not been on full song. And what's happened is that, in anticipation, a lot of auto stocks have run up recently. But I think there is at least 6 to 8 quarters of very strong performance in autos from the point at which it becomes, it starts. So once you see 1 or 2 quarters of outperformance, you can expect that will continue for a few quarters with some pent up demand and fresh demand coming in. So autos is one area I like. Financials I like. Um I think domestic consumption oriented specific opportunities in discretionary side you should look at. Uh, I am not a proponent of high P, high priced domestic consumer names, but I'm sure that you will be able to find enough opportunities. In fact, some of these companies, just to take a specific example, I won't name the company because we're evaluating it, but there are a few cases where companies have European arms, or European manufacturing or exposure through European subsidiaries, where business is getting disrupted temporarily, and the prices have corrected 40-50%, 60% from the peak, and the multiples are very attractive, low double digit, or high single digit even. So look at that. Look at companies where disruption has affected near-term performance, or stocks have corrected substantially, and the 5-year, 10-year visibility for earnings growth is there. And of course, without saying pharma, I think very much is in that pack as well.
Thanks, Tushar. So I see another hand being raised by Pritish. So Pritish, I have unmuted you. You can go ahead and ask your question. Okay, Pritish, I don't know.
Hello.
Yeah,
Yeah.
Pritish, go ahead.
Am I audible?
Yeah, please go ahead.
Yeah. Thank you, Ankit, and thank you, Tushar, for giving me this opportunity. It's a bit of like special situation kind question. So what has happened just now? Not wanted to be stock specific, but demerge entity. So how do you rate this situation, and how should, as a retail investor, we should approach this? Especially Piramal Pharma, if you can guide bit upon that.
So Tushar, could you hear the question properly? So Pritish is actually asking about demerger opportunities. Tushar, you are not audible. I think you have to check your system. Maybe you have muted yourself, Tushar. Check your system. You're not audible. Tushar, can you hear me? Okay, maybe Tushar will rejoin. Till that time, I see another hand being raised by Prince. Sure. So, Prince, I'll come to you once Tushar answers the question of Pritish. Just waiting for Tushar to come. I hope all of you got some real value about investing. So generally in our guest webinars, what we do, our guest deep dive on one particular company or investing idea. But with Tushar, we thought we should try to change that format a little bit. We thought that it's better that he shares his own experience with a lot of examples. That way you get a much more broader flavor of how Tushar and MK Venture invest, right? So the whole idea about these webinars is to try and get as much as different and variety of investing grades or veterans over here and learn from all of them. See, you need not copy everything what he is doing or anyone else is doing. But when you listen to different kind of people, your understanding gets much better and you can be a better person to take that call as to कि किसके तरह करना है मुझे ये. So it doesn't mean that all of us have to do an SIP in investing. Maybe all of us are not suited for that. Maybe some of you are suited for commodity investing. Some of you may be suited for momentum investing. So our effort at SmartSync services is to get as many. I see Tushar joining again, so let me just. Yeah, Tushar, I've unmuted you. You can. Tushar, can you hear me? I've unmuted you. You can probably speak. Tushar, can you switch on your video so that we can see you? And again, you are still muted. Yeah. Now I think you have unmuted yourself.
Let's be video off. I think you can still very much hear me. I'm happy
Yeah,
with the question. I had some issues, so I joined from my phone.
Sure. No problem. So Tushar, the question was related to, I think Pritish asked that question as to, Pritish, would you like to repeat? Because I just lost what was the question.
So my question was more of the special situation, how to react on those.
I got it.
Especially for this demerge, activity, what has happened. Yeah.
Are you referring to any specific company or in general how to play special situation?
Tushar, he was referring to Piramal Pharma and talking about demerge. So just like Piramal Pharma, we also had that another company. I'm forgetting the name of that company now. Where the R&D division and then the CRAMS division. Suven. Yes, you're right.
Okay. Yes, I think I would not like to comment on a specific stock, and I certainly I think there's a lot of questions in pharma, so I anyways don't want to comment on specific sector alone. But in general, what I do want to highlight is one very important thing that happens in special situations is that it is a forced value discovery exercise, right? You are forced to look at the valuation aspect again from scratch for the demerged entity as well, for both the entities that is getting listed separately and for the entity from which the other entity has been demerged. So what it ends up doing is, in the combined entity, you don't know who was valuing the on what sum of parts basis, right? but when the demerged entity comes, it becomes easier for you to take a valuation call. So let's say Piramal Pharma, at least, without commenting what I think is the right value, what I will say is that today, that the stock at say 160 rupees, you are getting it at 18,000 crore odd market cap, right? 18,500 crore market cap, and what I think about 4,000 crore debt. So you're talking 20,000, 22,000 crore enterprise value. So you are getting a straightforward exposure to a particular business on a specific multiple. Now, if anyone had invested in Piramal Enterprises combined entity for the financial services business, he would end up, having no need to hold on to Piramal Pharma, or he would not have a view on Piramal Pharma. So by default, the guy will be forced to sell, irrespective of whether he thinks this is the right time to sell or not. He doesn't have a mandate to hold to a pharma company. Likewise, there would be few people in the consolidated entity who were not very positive on the financial service business, but were holding it because they had hopes on the pharma business. Now with the demerger, they have an option to directly buy Piramal Pharma, and therefore no need to hold to Piramal, the parent entity. So by default, when these kind of situations happen, both the businesses, you will see some technical selling. And I say technical meaning it's a forced selling that will happen. And there is a large liquidity event. So a lot of sellers who were looking for exit otherwise also know that they could not have exited in normal market, will use this, these special situations being large liquid events. So you will see more selling happen because some of the institutions will use this as an opportunity to exit. So the way to play these things is that you have a fair value decided in your mind, and if the stock comes to that value, you buy. As simple as that. Rather than trying to take a view on every single event that happens, the same thing with OFS, with these preferentials and so on. All of these are special situation events. There are two ways to play. One is that you are only doing a trading bet. So, you think a good price, you get in, you have a stop loss. If it hits the stop loss, you move out as a trader. But as an investor, you have some understanding, I am assuming, of the business, underlying business. So you have some anchoring to what valuation it should trade at. And once it reaches that valuation, so let's say a Piramal Pharma, if you think is good at 130 or 140, if it comes to 130, then you buy it at 130. If after that it goes down to 100, that's your luck. Or it may so happen that it doesn't come to 130, it reverses from 160, but your original valuation anchoring was at 130. So you miss the opportunity, and we cannot attend every party in the town. So you will miss out on most of these opportunities. But the best thing to do is either have a disciplined approach from a long-term investing perspective, or you may trade in, trade out with clear stop loss.
Thanks so much, Tushar. So I think it's already 1:55. I'll take one last question from Prince. Tushar, you have already done a very good Twitter Spaces with Prince. So I'll just unmute Prince, and he can provide.
Ankit, one more thing. We can have a 10-minute quick fire if there are 7-8 questions that you think are relevant, and but interest of time we are not able to cover. We can do a quick fire 10-minute squeeze out. So I am happy to answer. If not, then we close out. Your call.
No, I have all the time. If you are ready to give 10 more minutes, that is very good for us. So let's continue. No problem. So Prince, you can start with your question.
Thank you, Ankit and Tushar, for such a wonderful session. And my question would be on the behavior side of investing. So again, as Tushar was saying, we were able to grab whatever knowledge has been shared. We are able to grab only 5-10% of that. So how to condition our behavior so as to gain maximum out of it, and how to handle the certain volatility which we experience in the market? Yeah.
First, good habits are only made over a period of time by continuous iteration, right? So if you think about it, if you have a 10-minute quick fire 10-minute squeeze out, so let's say a Piramal Pharma, if you think is good at 130 or 140, if it comes to 130, then you buy it at 130. If after that it goes down to 100, that's your luck. Or it may so happen that it doesn't come to 130, it reverses from 160, but you will miss the opportunity. And we cannot attend every party in the town. So you will miss the So it's like brushing your teeth. बस रोज सुबह उठ के करना है तो करना है. It can't be taught. It can only be imbibed. You know. So see what I think the best way to do it is every single time that you're taking an investment decision, you have a checklist or an approach or a framework that you're following, right? And we will have framework, but in the heat of the moment, nobody. If let's say a stock falls 10% and I have a quick investment opportunity, I will not go back refer to my checklist से कि ये valuation पे आ रहा है लूँ कि नहीं लूँ, वो नहीं होता है. But you go back periodically, let's say every 3 months, you review your own investment thought process, see where you're deviating, and you attend as many of these events. See, there is a reason why you have hundreds of books on investment wisdom and you have so many sessions and seminars like this all the time, because there is no one right approach. You should keep listening to people, keep hearing views, keep analyzing and think. Well, actually, we are paid in markets to only analyze and do this behavioral thinking. We are not paid in market to understand businesses beyond a point. What people have converted investing is into an exercise to track, what products are being shipped out every day, every week, every month. But that is not how investing is done. You can't model, let's say कोई कंपनी के 25 प्रोडक्ट है तो आप 25 प्रोडक्ट का मंथली डेटा ट्रैक करके क्या इन्वेस्टिंग करोगे बॉस. The only thing you do is you build a perspective on the company for which you do that one time effort, and then you spend a few minutes every month or every quarter to see whether the thinking of that management is in the right direction and aligned to your original investment thought process. You have many hours free every day only and only to actually read, listen, hear people and form an investment opinion and keep iterating it towards perfection. That is what we really get paid for. And what we end up doing in most cases is actually tracking markets endlessly instead.
That's a wonderful point, Tushar. Thank you so much for beautifully putting that up. So we have two more hands being raised. One is Mr. Dilip Bohra. So Dilip Bohra, I have unmuted you. You can ask your question.
Hello, sir. Thanks for the wonderful presentation. Thanks, Tushar, sir. Ankit, sir, too. So, first of all, I would like to know that for a top-down approach, say for a specific product, if there is a macro news, just which Tushar, sir, mentioned as anti-dumping duty or maybe any other thing, we have a X product and we want to drill it down to the companies, listed companies, that which are the listed companies in the BSE or NSE. So how could we go about it? And second follow-up question is, in the last closing comments of the presentation, he talked about three important things related to leverage. So I wanted to just recite it once again.
Sure. So first, very quickly on the leverage, I think the point is that three kinds of leverage absolutely kills portfolios. In fact, I would say four kinds of leverage, if I may extend the philosophy. One is that the portfolio itself is leverage. So investor has highly leveraged positions. You have 100 rupee capital and you're in 300 rupee investment. So you have taken borrowing to invest in markets. So leverage at a portfolio level. The companies that you invested in are leveraged, and the promoters of those companies can be leveraged. So you have pledge and so on. So there are three different kinds of leverage. In bad times can hurt, and the fourth is when the market valuation multiple today is borrowing from the future earnings, far beyond into the future. So let's say all these newly tech listed companies, which you expect will make profit 5 years, 10 years down the line, and the business will be 10 times bigger, and you're trying to ascribe valuation to that thinking today, you're setting up for volatility in these situations. Coming to the other point on how to track competition, etc., or specific products, I think the best way to do it is, you read as many annual reports. If you can't read annual reports, I think one very, very potent source of information is your con calls. So if you pick up,
I'm sorry, sir, but
yeah,
slight disruption.
so, can you hear me now, Dilip?
Tushar, I think you are fine. I think it is at your end, Dilip. So Tushar, please go on.
Okay. So, my point is, there are enough reports available in the industry that highlight, and each company also typically, in con calls, if you see, people do ask about competition, people do ask about product leadership and these kind of questions. So you have to pick up from that. Over a period of time, you will pick up. So let's say if I have to start in defense today, let's take an example of one sector where there are number of products and number of listed companies, or automotives, right? I think the first thing to do is to segregate the industry into specific pockets. So within defense, you'll have companies that are dealing with army related products, companies dealing with navy related products. You could have companies dealing with avionics, or you could have companies dealing with mechanical engineering, companies dealing with electronics. There will be some system integrators. There are companies dealing with drones. So you first break down into product categories. Then you try to look for some reports relating to those categories that will sort of list down the companies. If you go to a specific company, if you know one company in that domain, you can check out their companies. If it's a recently listed company, you will actually get the list of competition from the IPO prospectus itself, right? And then you build out one step at a time. But generally, the kind of world we live in, information itna available hai. It is the intention to find out. I don't think it is a problem. If I decide today to find out automotive entire value chain mapping for a given segment, I don't think it is hard to map the listed universe. Or one more alternate way to do it, it is, let's say you like automotives as a sector. You list down, there are 80 listed companies in the sector. You list all of them down and do a quick read of screener पे जाके आप बेसिक भी पढ़ोगे तो आपको 5 मिनट में समझ में आ जाएगा कि और एरिया क्या है उस कंपनी का. And you start creating the pockets. So there are 8 or 10 listed tire companies. There are 7, 8 listed ancillary players to relating to tires, right? There will be specific companies relating to transmission. There will be specific companies related to battery and battery technology and EV as a whole. So you start building out those pockets. It will be a one-time exercise to really map out, and then you can take do more reading to do a bottom-up view. So hope it answers the point, Philip.
Philip, I hope you got the answer, right? Okay, so Dilip is muted. Maybe we can, Tushar. Yeah, so I think we can take one last question.
Sure.
So actually this is a, okay, I'll let Aditya go first and then we'll see. Yeah, Aditya, you have been raising your hand for a long time. You can go ahead.
Yeah. Hi, Tushar. So, my question is related to CDM as a sector. So, I see all the things are in place for what we invest for long-term investing. Okay, there is a long runway of growth, long runway of cash flows, everything. So, do you see this sector as next IT sector for India? And mainly, I'm interested to know what are the antitheses in this sector. Because, yeah, I can go ahead.
CDMO.
Yeah.
So obviously there's contract development. I suppose you're referring to pharma in that perspective, right? Contract manufacturing pharma, CDMO.
Yes.
There's a huge runway. See, but one thing, right? It is in this sector. You have to take view on the capabilities of specific firms and the right to win they have, right? CDMO is an abused word. A lot of organizations pass off contract manufacturing of generic products under the CDMO head, right? But if I were to stay true to the definition and identify organizations with strong chemistry skills and working with innovators on specific products, it is a no-brainer that this segment will continue to grow, simply because in general, resource cost is moving up globally. The West has always had the resources at a much higher cost, and the capability gap at the top is actually thinning down. So you have in India, for example, pharma is a very well developed industry, and availability of
Tushar, your voice is breaking. We can't hear you.
I had a call. So I'm saying that the challenge with India has been on ability to show original research work, but when it comes to working on processes and analytical capabilities, working with the innovators, I think we have a very well established industry and body of knowledge, and our resources are to that extent much cheaper as well. So the same work can definitely get done much cheaper in India. A lot of corporates had issues outsourcing work to India or development related activities because of IP reasons. But I think with a number of companies having been established in this space and growing with scale and with well established processes, that barrier is coming down, and the cost arbitrage is definitely working to reduce that barrier further. Plus, some of the Indian companies are, hiring global leaders and creating that lobbying specifically at global level, and also capabilities and capacities globally. So to mention in context, Piramal, for example, right, the recent listing, they have manufacturing facilities globally in US and Europe for catering for CDMO projects. So as a overall trend, I think there is a lot of move definitely possible in this space. I think there's a good runway for a 20% plus CAGR in this industry for next 10 years. The antithesis to this would be you have to get the bottom up right. Not every company will do well in not every space. For example, a lot of the incremental opportunities are in biologic side, but DVs is not catering to them. Therefore, you have to take a specific view on what products DVs will do in the next 5-10 years, and they have a huge runway for growth themselves. But if you're looking at biologic CDMO, DVs is not the player to be, right? So that way you'll have to cut across the spectrum with specific questions that what you are looking for, and specific answers will reveal the investment choices. But overall, I think it's a lot of potential. And second thing is CDMO is volatile business, lumpy business. What we assume the pace of growth will not be that way. You'll have 2-3 quarters of very sharp growth, and then 2-3 quarters of disappointment also. So you have to be able to digest that disappointment and know that 100 will go to 500 in 10 years. But before that, it can come to 80, then go to 150, then come to 130, and so on.
Thank you.
Interesting. Yeah, I have another question. Can I ask or?
Yeah, sure.
Okay, so this is related to caustic soda players. So there is kind right now going on Euro +1 or China +1. But when we see all the caustic soda players, right, they are moving across the value chain. They are not sticking to selling only caustic soda. They are going to derivative segment or though. So right now, is this juice is over in this sector, or because we see there is no kind of volume growth in it. When we see that it is only price driven growth they are earning, but they are moving across the value chain. So as an investment perspective, should we stick to that or should we think it as a commodity and exit? How do you see this space, Tushar?
Yeah, the best way to look at this is now, because it's like a lottery. Commodity sector hai, you get a time, there are times where in the industry when you get an opportunity to clean up your balance sheet and to invest significantly in value addition, right? Not every company will take it. A few companies already today, so let's say someone like Tata Chemicals, for example, right? It's already a well diversified across multiple products, and that house has the capabilities to transition this into a much bigger business, right? But some of their other peers may continue to see this as a temporary windfall gain. They'll, if the 100 rupee product goes to 250, 300 rupees quickly, you see a very sharp profit move up, and then it will fizzle out also. The important thing is you as an investor, what are you trying? Are you trying to look at the business for a short term tactical gain? तो अभी भी बहुत opportunity अभी भी है maybe. If we are looking at it from an investment perspective, then you can't invest in this industry only for a temporary disruption. You have to identify and invest in players who will use this disruption to let's take a example is more relevant. तो एक्सेंट्रिक है थोड़ा सा, बस अभी केबीसी में 50 लोग आए, ठीक है, 50 के 50 लोग को लॉटरी लग गई, 1 करोड़ रुपए जीत गए, वो 50 में से 40 लोगों का ना वो 1 करोड़ रुपए 2 साल 3 साल में गायब हो जाएगा. They would have spent it out. If anything, few of them will actually get further into debt or trouble, because with that 1 crore rupee, their lifestyle change will happen, but their earning capability will not happen. Only 10 out of those 50 people or 100 people will use that money wisely, invest it, significantly. They will have a process how they want to use that money to better their lives and create value. तो तुमको वो 10 इंडिविजुअल आइडेंटिफाई करने हैं जिनको वो लॉटरी सबको लगेगी, वो लॉटरी से फायदा करके कौन अपना जिंदगी परमानेंटली सुधार सकता है, दैट इज द क्वेश्चन. सो आइदर यू से कि यार इसको लॉटरी लगेगी तो एक बार का टेम्पररी खर्चा करेगा तो अपने थोड़ा कमाई होगी, तो एक बार या तो वो कर रहे हो यू आर ट्रेडिंग, और यू आर सेइंग कि बॉस ये लॉटरी लगेगी तो ये बंदा अलग लेवल पे चल जाएगा. इफ दिस गाय हैज मनी, इफ दिस गाय हैज बेनिफिट, he will move to the next level. Your aim should be to find the company which will move to next level. And I'm sure with that in mind, there are only 1 or 2 names in caustic soda as an industry.
Yes, वो समझ गया. Yeah, I got it. So we should stick to that because here the bias is like it is commodity, right? तो अगर वो hit हुआ, अगर they are in the transformation, so should we exit, or in that sense I was there, but okay.
I can't say a specific
Yeah.
exit entry call, but I think
Yeah.
disruption is here to stay for some time.
Yeah, got it.
If I may say so.
Okay. Last question I have. Can I go ahead?
Quickly, Aditya. One last.
Okay, last question is, so I'm from IT background, okay? So when I see all the IT companies, right, when you talk about particular company, since you are from non-IT background, but you have very strong thesis in, suppose take Tata Elxsi or any other IT companies, you know that okay, they are foraying into this, suppose they are foraying into OTT, AI, machine learning or something, this sort of. But the groundwork, how do you calculate and how your thesis play? Because okay, you can think via the numbers are coming, so you can think the bias is okay, they are in the right direction or they are foraying into the right chemistries or right technologies. But how the groundwork you do here, Tushar? This is the last one.
I think you asked so many questions on pharma and chemicals. It was hard to guess you're from IT, boss. How long have you worked in IT?
It's been 4 years. I'm in IT domain, but yeah, this is my passion, stock market. So
Fantastic.
I've been involving. Yeah.
Acha. Regarding your second observation that I'm not from an IT background,
Yeah.
I actually worked 4 years as a business analyst at the start of my career in TCS.
Okay.
So I have very much, if you look at number of years, you and I have the same experience, boss.
Yeah.
So,
Okay. Sorry.
So I'm very much from IT background in that sense.
Okay.
Anyways, so not to pull your leg. See, not that I have a extraordinary understanding or you know any proprietary insight on Tata Elxsi, for example, right? Whatever a little I have done is basically I have taken public data. I have gone through few of their con calls. I had a hypothesis to start with. That hypothesis got built basis some early reading that I did on the company and some of the peers. So I had a starting hunch. Let's say I looked at 7-8 companies in the sector. On that, I had a starting hunch that within these 7-8 companies, this one company looks interesting. So I read up a little bit more about that. When I read up a little bit more, I was able to build an initial hypothesis that there is a clear right to win for this company. To perfect that, I went through, let's say, 8 quarters of or 6, you know, it's some 8 or 12 quarters, I don't remember. Obviously, I have gone through all their calls now, but when I first did the exercise, I think I had gone through 8 quarters of con calls, previous 8 quarters back to back. And I focused on what is the capability being highlighted by the management or the areas in which they are highlighting work being done. So those keywords that you saw on the slide, 5G, AI, augmented reality, OTT and all that, that is not something I have dug deeper and talked to industry people hundreds of hours of effort. It is just reading through back to back on one Sunday through 8 quarters of con calls and highlighting and marking and taking notes. And when you put those notes in one place, it is very clear that the company is working on every single disruption. And it is not to say that they are the only company doing it. Again, if you do the same exercise for a Persistent or an Emphasis or a Tech Mahindra, maybe you likely to get equally interesting insights. And maybe I'm guilty of not doing it for a lot of the other companies. But what I'm trying to highlight is जब बस अपने को एक सेक्टर में ना हर कंपनी में तो दिवाली मनानी नहीं है. What we are trying to do is if you identify one company for 20 years, you think ये company, and the starting point at which I identified it was not that expensive. Right. And with a period of time, the delivery has happened. The execution has backed the thesis. And therefore, my interest today is maintained despite it being expensive. So it's not that because 5 years back I chose a company, I must stick to it today because the company has done well. The execution is because of the execution that the re-rating has happened. But if I were to do that same exercise today, let's say today if I want to do that exercise for persistent, I will go through the last 7-8 calls. I will read up. See, एक बहुत बड़ा फर्क होता है annual report और con calls में. Annual report is static data, meaning
Correct.
it is presented with some careful curation of thought process at a given point in time. So management knows what they want to say in an annual report. Despite the regulatory structure of the AR, management knows exactly what needs to be put in the MDA section, how they want to present the story. But a con call is happening in real time. It's an extempore. And it is in an extempore that the slips always happen. You tell more than necessary, or you give more information than required, or you come up, you highlight your vulnerability that you will not highlight in an annual report and so on. So if you really want to pick up the nuances of a company, you actually go through not just one call. You read through a series of calls on a continuous basis and take notes. And then you consolidate those notes in one place. You will learn far more about the company than any number of regulated data can tell you. So that is what I would do, and I will reform an opinion on a corporate. In fact, as we speak, I am actually very much looking at IT sector because there has been a sharp correction, and I'm amenable to doing this exercise for a few companies in the sector.
Okay, Tushar. Thanks for all.
Devanshu had a question. I think the hand's been up for some time. We take that as the last
Yes.
one. Ankit, let's then.
Yes. Devanshu, you have just 30 seconds. Please ask your question first, and your question will be the last question. Where are you? Okay. I've just sent you the request. You can unmute yourself and ask.
Yeah, hi. Can you hear me?
Yeah. Loud and clear. Go ahead.
Thanks, Tushar, for a great session. Firstly, so I just have two questions. I'll try and keep it brief. So, how do you think about position sizing now, right? Do you use the help of stats, or you keep it something simple, like wanting to take up, say, up to 5% exposure in 20 stocks? So that's how you think about like 100% exposure. And also from the angle of letting your winners keep running, or do you keep cutting position sizes as they become sizable? So that's one part. And secondly, also relooking at some of the investment ideas whenever there's a management change. So just to take up example of CCL, which is a stock that I've been tracking for a while. So I think long-term investors have gotten lucky because the second generation guy who's come in has taken up the company a one notch higher, right, in terms of corporate governance and simplifying the structure, and now again relooking at the B2C business, as you mentioned. So we got lucky in some sense, but that will not be the case across, especially when you're looking at businesses from a 10-20 year perspective. So what's your thought process from this angle? Just these two questions. Thanks a lot.
Devanshu, I'm glad you brought up the question on CCL. Unfortunately, I didn't want to, in the sort of prepared thesis highlight this point, but as an answer to a question, I'm happy to. Well, actually, one of the reasons for me to be bullish on CCL today is the management change. I have tracked this company for 10 years almost, right? And I know Srishant personally, obviously, since we've interacted with management several times over the years. So I know him personally. At least one, see, and this is what, again, the part of keeping investing thesis simple. First, my thesis itna simple hai that unfortunately it will not even gather, pass muster with a lot of the investors. My thesis on CCL is very simple. The second generation had a well-established leadership position. He inherited a business that was already doing very well in the core thesis, right? Which was the instant coffee processing. They were already doing very well when Srishant joined the business early 2012-13 sometime. So for him, it was very easy to say कि यार ठीक है बाप की company है चल रहा है अच्छा सब बढ़िया हो रहा है क्या tension है and not really capitalize or build up. But you see the background of the guy. Lawyer by qualification, well-read, well-educated, soft-spoken, and he's a very sharp and confident guy, and he has a very clear ambition and passion. And it is over 6 years of execution that people are now finally starting to see the fruits of what he was intending. Their work in domestic branded coffee started, I think, in 2014, if I'm not mistaken. 14-15 se they are working on it. And today in 22, so it's actually 8 years of effort finally they have built a 150 crore brand with absolutely zero additional requirement, or cost. They've not had a real hit to the balance sheet in last 8 years because of the investment, and it's already a 200 crore brand now. Next 3 years, this 200 can easily be 500-600 in domestic alone, and they have a capability to build a 500 crore brand in global, in US and Switzerland, for example. So this 200 to 1000 journey will be much quicker and more visible. So one of the reasons to be bullish on CCL in this round is that the second generation is capable, and the execution continuity is there, and a very clear thinking to what he's attempting to do with the organization.
No, I
So-
agree with you. I think there's, very calculated aggression, if that's the right word, from his part, I think, and especially especially whatever they've announced off late, which is, never been the case in the at least earlier in the last 5-7 years that I've been tracking it. It's quite aggressive right now.
Exactly. He's converted the instant coffee processing business into a high value addition business. He started to focus from bulk coffee to packaged, small pack variants, which is a much higher business. They're investing in labeling. They're setting up capacities in US. So they're doing a lot on the instant coffee business, as well as they're doing a lot of aggression on branded coffee, and they're doing a lot of interesting non-coffee variants. So to answer your question, nobody knows this on day one. So that is the reason you track, you look at what the management is highlighting every quarter by quarter, you sort of build the thesis, and it eventually plays out over many years. And that is what I said, to start with, that this is not a sprint. So you have to build some of these positions over many years. And that is where the comfort is. So today I may not track that business day in, day out like a lot of other investors may be forced to. But my thinking here, I know exactly what's happening. I don't need to track that business as much today to take an investment call. So, so maybe you may think that we got lucky. I would like to say that we observed, we were careful to know what are the monitorables in the company, and we observed, and we are happy to see the progress, and therefore we can continue to stay invested, or you can continue to sort of stay engaged with the company. So it is an observation. Obviously, we get lucky. Not every company would do that way, but that luck is also created by our ability to know what to track.
Sure.
And the bet sizing question, I think there is no right or wrong approach. A lot of people run down on the investment winners as they become too big to cut down the risk and generate fresh capital for other stocks. A lot of cases you would like to continue to add. So it's like a subjective, it's like an art boss. अगर ये पेंटिंग 100 रुपए की है कि 1 लाख की है, या 10 लाख भी मिल सकता है, you'll know only with period of time, but you can have some starting assumption. So among few of my current stocks, I won't name the stocks, but there are few of the current winners which we did exit at very good valuations, but stayed invested emotionally and mentally. So we are continuing to track. And in few of those cases, we reinvested at when we thought the time was right. And in 1 or 2 cases, I have actually built up at all levels, irrespective of the valuation or the price, because there the perspective is that, well, you don't know where to invest this money. If you exit this company, I can't find a better worthy competitor in this space. So might as well continue to invest here only, क्योंकि at least जहाँ पे मेरा 15 साल का व्यू बना हुआ है, or I don't need to do a day-to-day tracking of that company. I free up bandwidth mentally to track a lot of other companies where I can anyways make good returns. So I would rather not aggressively deploy capital in this winner. जो पैसा बन रहा है उसको बनते दोगे, और in fact I will continue to add fresh capital gradually, and I will, the time that I get freed up, because मुझे इस idea को track करने की जरूरत नहीं है, that mental bandwidth, that investment of time I will do to identify more winners like this at early stages, and then I will start with small seeding bets in those winners and gradually build up positions there as well. I hope I am able to bring out the point that I'm saying. So there's no one right or wrong approach. You have to do both depending on case to case.
No,
Thank you
sure.
so much.
That answered my question. Thank you.
Thank you so much, Devanshu, for asking that question. I just wanted to add one color to the CCL discussion, which because CCL, Tushar, we have been discussing for a long time, personally also. So What I like about CCL and Challa Srishant is that you will find very little information on the annual report. Even on calls, he will be very measured. He will not give out so many things which you want to know about them. So that also tells you a lot about the maturity of the promoter, right? Because generally you will see promoters coming to the TV channel and flaunting a lot about their business. But this is one guy who knows what to do, and then he doesn't want to give out too many things to you, right? Do you agree with me on that, Tushar?
Yeah, absolutely. You're right. And there is a great joy in identifying such kind of companies where you are able to take a 10-year view and the management is so mature.
Right.
So Srishant is, I mean, without trying to give any buy or sell recommendation, frankly, but there are
Exactly.
very few people you come across who have that level of maturity for second generation.
Right.
And
Exactly.
on a closing note, there are two kinds of investment where it gives you great joy on the outcome. One is where there is zero discovery. As the stock gets discovered, right? So the thrill of you having been proven right and the world catching up is immense. But there is an equally big thrill to happen in making money in well discovered opportunities also. You know,
Exactly.
so like I mentioned that SBI versus HDFC point.
Right.
That is also a very good approach to making money. Just that it is a harder approach to in a well discovered stock to make money, but equally satisfying.
Right. 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 So, Tushar, as I look at the time right now, so you you have spent 3.5 hours with us.
That
So,
is
thank you
2 hours
so
more
much.
than what I had budgeted. Thank you. But
So, I told you yesterday only that time I let the guest and the audience decide about the time. I never have any control over the time. So, thank you so much, Tushar, and thank you so much, audience, because some of the questions were really, really interesting, and that helped us improve the quality of discussion. Unfortunately, I couldn't take all of the questions, but I tried to take all the questions which were very, very, very relevant. So thank you once again, Tushar, and all of you who joined on this webinar. We'll put up the recording as soon as possible so that more and more people can watch it. Thank you once again,
yeah,
Tushar.
thanks
Have a
for the
nice
opportunity, Ankit,
Sunday
and thank
with your
you guys
family.
for taking time out on a Sunday to hear me. Really appreciate. Thanks.
Thank you, everyone. Bye.